Hello, welcome friends. In this video, we are going to discuss about fund accounting related class. So, what is there in fund accounting? Why we required for this fund accounting, and what are the terms, main terms we are using in fund accounting? Firstly, for fund accounting means we need to ensure the records, keeping the securities holding and cash levels, facilitating NAV calculation and reconciliation. Here, the fund accountants with the fund accountant, he will calculate NAV calculations, and he will also ensure the whatever the securities he is holding and whatever the cash levels they exist in the fund, they will account that records, and they will maintain the records in a accurate manner. So for the become the fund accounting, you must know some terms here. So mainly this fund accounting means they will ensure the accurate records, keeping the securities holdings and cash levels, facilitating NAV calculation. Whereas investment banking means if you are want to go any IPO process, then in the during of IPO or at the time of IPO, they will provide advices, they will give the structure, and they will help in the mergers and acquisition, will provide the helps in this is investment banking. Now we have different persons in this a market. So there may be custodians, there may be AMCs, asset management companies, and fund accounting and RTAs, registrar and transferor agencies, fund administrations and auditors, stock brokers, prime broker. Different persons will be exist in fund accounting. So we will see who is the persons will be there in India and where they are exist as of now. So in India, if we see top companies, that is mutual fund. For mutual fund, we have large players will be there, and after the large players we have mid-sized players will be there, and special players will be there. So for large players, the one will be HDFC fund will be there, HDFC mutual funds. It is located in Mumbai. ICICI Prudential Mutual Funds, Reliance Mutual Funds, SBI Mutual Funds. So these are the large players who are existed in India. After that, mid-sized players, that is Axis Mutual Fund, Mumbai, Kotak Mutual, Mahindra Mutual Fund, and UTI Mutual Fund. So almost all mutual funds are these stocks, the AMCs, all are mainly located in this Mumbai itself. So all next after that, specialist player, that is quantum asset management. These persons will focus on mainly some focused funds. So they will take some information and say they will focus like real estate or infrastructure or hedge funds. They will focus on some funds only. Quantum means they will use that more technology also. And DSP Black Rock, that is international fund in Mumbai, and private equity funds. In private equity funds, the large firms are Swikia Capital India, that is located in Bangalore, and TPG, that is Mumbai and Bangalore, and Blackstone's India, it is located in Mumbai, and KKR India, this is located in Mumbai. These are large firms in private equity. Where has mid-sized firms? So in mid-sized, Arena Capital, that is Mumbai, Charis Capital, Mumbai, Carrier Capital, Bangalore, and Mayfield India, that is Bangalore. After that, we have sector specific firms, Helen Venture, Bangalore, and Temsik Infrastructure, that is Mumbai, CDC Group, it is located in Delhi itself. After that, we have seen firstly mutual funds, after that private equity funds, and after that we are seeing now hedge funds. So mainly in fund accounting, you will see the main conceptual wise in private equity, mutual funds, and hedge funds. After that we will discuss some normal funds which we existed in this fund accounting. So hedge funds will be traditionally, mutual funds will be there, Alpha Zero Capital, that is in Mumbai, and Altria Capital, that is in Mumbai, and Value Crest Capital, that is in Mumbai, and where has longer short. So longer short will be DSP Opportunities Fund and Quanta Magnum fund will be there, and some event driven funds will be there. Event driven are ICICI Prudential AF, event driven Mumbai, and Motilal Oswal event driven investing fund in Mumbai, and some master fund and feeder funds. So we will know about this master fund and feeder funds also, where they are located based on their location. Their names will be changed: master fund and feeder funds. Feeder funds means they do not invest any amount, they just collect money from the investors and they will feed to master, that is feeder funds. So master feeder structure, master funds will be Axis Master Equity Fund and ICICI Prudential Master Value Fund, Reliance Master Opportunity Fund, and some feeder funds are HDFC Small Mid Cap and Feeder Funds, SBI Infrastructure Feeder Fund, UTI Nifty Bank Feeder Funds, and some fund accounting houses are different fund accounts will be there. Largely global firms are PwC India, KPMG India, Deloitte India, EY India. They will maintain the accountings. They will located in different cities also. One Mumbai, Bangalore, and other major cities they will excel. Then some specialized firms. This SSC and C in India, Bangalore, BDO in India, RBSC advisories. These are the some specialized firms and some custodians. So in custodians, large banks which have the ACICI, HDFC Bank or Citibank or Standard Chartered Bank of India. These are all custodians banks. They will custody or in these companies there na, that private equity or hedge funds, they will invest money in some shares or securities. That shares will under the custody of these custodians. Next, depositories. Depositors are two depositories. One is NSDL and one is CDSL. Next, AMC companies. AMC companies is same like as same as mutual fund houses, which are mentioned in respect to locations itself. Next, RTA. This is registrar and transfer agents. So these persons will maintain the data, and large players were Carvey Computer Share, that is Delhi, Mumbai, Bangalore, other cities they are located. Camps, that is also there in Mumbai, Bangalore, Chennai, and other cities. Link in Time India, this is there in Mumbai, Chennai, Hyderabad, other cities. And after that, some fund administrator will be there in global reforms. Invoke Go India Mumbai and BNP Paribas Security Service India Mumbai, and Indian firms are ICICI Trust Services will be there, and some stock brokers and prime brokers will be there. So who is the stock brokers? Here stock broker, discount brokers are this Zero, the Upstock, Five Pies Capital or Angel Broking, and for full service brokers are ICICI Direct, HDFC Security, Motilal Services will be there. And prime broker means who will collect some prime membership, they will provide more services. So IIFL Prime Wealth, Head Wealth Broking Mumbai, Nomura India Mumbai, and some general partners. So means we will see in the concept this all will be included in respect to times. We will discuss about these persons. Some general partner. General partner means we have seen that Swikia Capital India, which is the first place is there na. So that is Bangalore. It was TPG. This fund GP means this is who is the person, main person who is maintaining, managing that fund. Selinder Singh, and TPG Abhijit Mukherjee Mumbai, and Adventure International, that is Sandeep Singhal Mumbai. These persons will manage that funds. This is known as general partners, and they will get the management fee and herself as incentive fee also they will receive. And limited partners, there may be limited partners, domestic institutional investors, that is DII, domestic institutional investor, that is HDFC Life Insurance, State Bank of India, LIC, and some FII, that is foreign institutional investors are BlackRock, Goldman Sachs Asset Management, Team Sec Mumbai. Some REIT means this is real estate investment trust will be there. Some Embassy REITs is there in Bangalore, Brookfield India Real Estate Trust Mumbai, Mindspace REIT in Mumbai. Some Invite, that is Infrastructure Investment Trust, India Infra and IT Funds Mumbai, Power Grid Invite Gurugram, IRB Invite Mumbai. Some venture capital funds also there. So venture capital at early stage, Bloom Venture, that is there in Bangalore, Kalari Capital Bangalore, Vine Corambattul Bangalore. Some growth stage. So in venture capital we have 4 to 5 stages will be there. So in that stages, one stage is seed capital, after that growth stage. So this also there. So now come to the main topic, that is fund accounting related information. What is there in fund accounting? In fund accounting mainly we will focus on three type of funds, three type of investment funds. Firstly it will be mutual fund, and after that we will discuss about private equity, after that we will discuss about hedge funds. This is the main conceptual. So in mutual funds we have, it will be open ended fund, means investors can buy and sell shares at any time throughout the trading day. So they can buy, they can sell at any time, they will not have any restriction this particular certain time only you need to buy, you need to sell. That is open ended funds. Entry is easy and exit also easy in mutual fund cases. They are also standardized offerings, that mutual funds will predefined investment strategy and some risk profiles will be there, and relatively they are lower fee will compared to other type of funds. So mutual funds generally have lower management fee. For example, Fidelity 500 index funds will be there. They track the performance of the S&P 500 index. So S&P 500 means this is like as our NSE BSE, only Nifty 50, a Bank Nifty, same like as S&P 500. Investors can buy and sell shares throughout the day, and the fund NAV is calculated and published daily. So in these mutual funds houses, the NAV is the net asset value will be calculated every day, daily basis. So up to 11 p.m. they will update the NAV, and after that this private equity. So private equity funds means this is close ended funds. These shares are issued only at the time of funds inception and cannot be easily bought or sold during the investment period. So in middle of the investment period it is not possible to sell, it is not possible to enter into this fund. So these are all private equity funds. These are all mainly invest in liquid assets. So prime equity funds primarily invest in privately held companies is there, and which can be challenging to value or exist, or this will be known as startup companies, or they may go for real estate. So they will see the illiquid assets mainly, and they will charge higher fees due to they have complexity of managing the illiquid assets. So private equity funds typically charge higher management fee than mutual funds. In mutual funds they will charge only management fee, but in private equity they will charge management fee, along with they will also charge some incentive fee also, we will discuss later. And example, for example, KKR North American fund will be there, focusing on investing in middle market companies in North America. So shares were issued in 2017, and fund has 10 years investment horizon. So they will go for 10 years or 8 years. So they will, that long term period will be there. So for that they need to maintain, they need to manage it for 10 years now. For that they will charge more amount. And after that we will discuss about hedge funds. Hedge funds means it is unregulated investment vehicle which does not have more regulations as compared to mutual funds. Mutual funds have more regulated because they invest more retail investors, but these in hedge funds or private equity, these are the persons who are have accredited investors, or also known as HNI, that is high net worth individual persons will invest in this person. So here this must have unregulated investment vehicle, and hedge funds have more freedom in their investment strategy. They can invest in any assets, so they do not have the restrictions, and they can utilize leverage and short selling also. This leverage or short selling means they can sell the shares before they have the shares. So with they can borrow the shares and they can sell, and after that they think the price is going down. When the price is went down, they will purchase and they will repay that shares and along with interest when they are borrowing that one. And they will also charge performance based fee will be there. In hedge funds often charge a carry fee which is percentage of profit generated above the high water mark. High water mark, we will discuss about this concept also. High water mark means previously peak of NAV. So NAV means net asset value. So yes, today is NAV is 100 rupees, tomorrow it will become 150. Then high net worth means high watermark will be 150, and after that NAV becomes that is 120. Then HWV is not change, only the 150 is crossed, then only you will get the incentive. So high watermark means they will put one point in when the profits was reached that position. Next, high risk profile. Due to their aggressive investment strategies, hedge funds can be more volatile than other funds, other types. So it is aggressive of mutual funds because they are investing in investment strategies are aggressive in nature, and hedge funds can more volatile than other funds. For example, if it is see that Bridgewater Associates Pure Alpha is global macro hedge fund that employs quantitative analysis to trade across various asset classes. So the fund charges 2% management fee plus 20% carry fees. That is hedge funds related. Now in this investment fund ecosystem, we need to know some persons, different persons who will involve in this fund accounting. So that persons are, first person, it will be custodian person. So custodian means who is the person safekeeping of fund assets, so securities and cash. So its function will be safe keeping of fund assets and securities. Now fund accounting means what? Fund accounting means they will ensure accurate recording and keeping the securities holding and assets level, so facilitating NAV calculation. So they will always booking the records, booking the accounts, and keeping that securities holding and levels will be accurately. That is fund accounting. And whereas investment banking means here may hold client assets in custody during IPO and mergers and acquisitions. So this person's securities is holding na, and this person cash holding na. This person will have IPO related paper documents, mergers and acquisition transaction related information. This all will be kept in this fund books. So these are all becomes a fund assets now. This fund asset will be take care of this custodian. So for example, if you see that BNY Milan is there, is a globally custodian that provides safekeeping service for various investment funds. So these investment funds, they will raise money, they will invest in securities. The securities will be kept in this custodian places. And asset management company, that is AMC. Here the asset management company means this is manage investment portfolio of funds according to their stated objective and strategies. So AMC means they will collect some amounts, and they will see their objective, what their objective they are stated, and they will go with that strategies. So asset management company in fund accounting, how it work? So they will provide transaction data and investment details to fund administrators for NAV calculation and reporting. So this asset AMC will provide some transaction data and investment details to fund administrators. So the fund administrator will account that relating for NAV calculation and reporting. So fund accounting. And AMC will help to investment bankers, so how they may participate in fundraising activities for new funds or advise on investment strategies. For example, if we see this BlackRock Incorporation, he is a leading global asset manager overseeing trillions of dollars in asset across various funds. Next, after that, RTA, that is Registrar and Transfer Agency. This Registrar Transfer Agent means maintain investor records, process investors transactions. For example, that investors means they have subscriptions and redemptions and distribute dividend and capital gains. They will distribute for they how they help for how they work for fund accounting. So in fund accounting, they provide the investors account data and transaction details for reconciliation and NAV calculation. So we need to know about that reconciliation of accounts. So I will discuss at the end of the class. So what is meant by reconciliation of accounts, why it will required. RTA will maintain that records process of investor transactions. So here investor transaction means all their subscriptions and their redemptions, and they will get some income and they will pay some expenses. And the fund accounting provide investor data and transaction details for reconciliation. For investment banking, they will provide act as a intermediary for investors communication during the IPO or other corporate actions. So corporate actions, we will discuss what are the corporate actions will be there, how the share price will be impacted for different corporate actions, we will discuss later. Next, fund administrator. Fund administrator means they are providing back office services for funds and including NAV calculations. So this will some regarding NAV calculation, record keeping, regulatory reporting, and compliance. These are all compliance work. This will taken care by the fund administration. So for fund administration in fund accounting, they are the persons responsible for the accuracy and integrity of funds financial records and reports. So whatever the fund records will be there and whatever the funds report financial reports will be there, this fund administrator will be responsible in fund accounting. And for the investment banker, these are the main partners with the AMC in the setup and administer new funds. For example, if we see SS&C Technologies is a leading provider for fund administration services of hedge funds, private equity funds, and mutual funds. Next, auditors. So who is this person's auditor? Auditor means who will independently review and verify the financial statements of the funds to ensure accuracy and adherence to accounting standards. So that fund accounting books are maintaining in accordance with accounting standards or not, they will verify the financial statement and they will review. This is the persons who have independently review the financial statements. So how they work in fund accounting in investment banking? So for fund accounting, they will provide assurance to investors and regulators regarding the integrity of the fund financial reporting. So that fund he is maintaining proper books of accounts, they will assure to our investors. In investment banker, they will provide some due diligence services on the financial health of the company, that is in case of during mergers and acquisition transactions or IPO, that is initial public offer term, they will provide the due diligence services. So DD services will also we will discuss later. For example, Deloitte Touches Thomas to Limited is a global accounting firm that provides audit service to investment funds of all sizes. Next, stockbrokers is the persons who will facilitate the buying and selling securities for investors and funds. So if the investor want to buy any securities or if the investor want to sell any securities, they will provide the agent. The agent are known as stockbrokers. So how they help in fund accounting? So stockbrokers may involved in the execution of large trades for fund and impacting the NAV calculation. So they will involve the execution in large trades for funds and impacting the NAV calculations. And in case of stockbrokers in investment banking, they will execute the trades for client during the IPO or secondary offering or mergers and acquisition transactions. For example, if we see Goldman Sachs is the leading investment banker with a global broker dealer network that serves institutional clients including investment funds. So they act as a middle person in case of this from stock exchange and investors. And some funds types and some options you need to know about the cases. So here the fund types will be open-ended funds or liquidity funds. So first of all, open-ended funds means what? Open-ended funds means, for example, these funds always will be open, that is buy and sell shares directly from the fund anytime. So this anytime is there na, anytime in the market is open. This is open market, that is open-ended funds. For example, your local grocery stores, so is a open market. Think fresh groceries available day and night. It is like a Raitu Bazars, and they have flexibility key. So they will invest regularly in lump sum and perfectly for building your portfolio gradually. For liquidity matter, they will convert your shares back to cash when needed, offering peace of mind. So whenever if you want money, they will give back to your cash. So it is then you are have a peace of mind. For example, Fidelity 500 index funds will be there that track the S&P 500, letting you invest in basket of top US company with easy. So it is easy to invest in US company by using this index funds. This is like as a grocery, local grocery stores. And after that, close-ended funds. Here close-ended funds means here at a one-time offering, means the shares will be released only through IPO and that then traded on a stock exchange, like really collectible, means they will give the time, means January 11 to January 20. So this is with the time, that is NFO period, new fund offer time. They will provide the new fund offer time. At that point of time, whoever the investors want to invest, they will invest. Other than that time, they will not allow enter, or they will not allow to go. And here the limited edition boutique goes, so they have fixed supply. There will be no new shares created or impacting price based on the demand and supply. So demand and supply, it will not work in the case of closed-ended funds because they don't change the portfolios, and they have less risk, less liquidity, because buying and selling can be trickier with wider bid and ask spread. So bid means buying price, ask means selling price, spread means the difference between the bid price and ask price. For example, Blackstone Strategic Opportunity Fund invest in various assets for capital appreciation or offering exposure to unique investment strategies. So they will go with the some unique investment strategies. So they do not allow different person entering at any time. Next, after that, interval funds. Interval funds means that some bakery with a special buyback days. So here they have interval hybrid approach, means this is common features of open-ended and close-ended funds. Means this house, for example, if we see close-ended funds, means they will open only one time, and after that 1 to 10 years they will not open. Up to 10 years you do not have any responsibilities, or you do not have any option to enter here. So if you want to enter here, some funds will provide some interval time, means in interval time means they will provide yearly some 10 days or 15 days time to invest and exist. So if any person want to invest, they will invest in that interval time. So fixed number of shares, that is similar to closed-ended funds, but with a limited buyback window. They will provide at a predetermined interval. They may offer quarterly, or they may semi-annually or annually. They will provide some predetermined intervals will be there, and there is controlled liquidity because they offer buyback window will be add flexibility but not continuously liquidated to open-ended funds. So they have only some predetermined interval they will opening. For example, Chone or Steve's Quality Income Realty Fund invest in real estate investment trust, that is REIT, for income generation. They will quarterly buyback period will be there. Now here, for example, you invest in stake, so you need to know about the units and unit capital. So here unit investment in stakes, unit means one piece, that is each unit represent your ownership share in the fund. Think of its delicious slice of pie. The more slices you own, the bigger you portion of the fund assets and their returns. So if we see cake of piece in the cake, piece of cake in the cake, it will become unit. So the entire cake, it will become the unit capital. So imagine the combined value of all outstanding units is equal to total fund size. Now for investing options, we have different options will be there for investing. So it will maybe direct options or regular options or growth options. So direct options means direct order at the counter. You may go there and you can order. They do not have any person in middle of this person. So walk into bakery, that is fund, and grab your cake which is you like the cake. You deal directly with the fund. So similarly, buying grocery without a delivery app, you do not have any middle person in between the you and that person. So So this is known as direct options. So when direct option, you do not have any middle person. And after that, regular options will be there. Here delivery services with convenience. So order your cake through delivery service. There some person will be there, agent persons, and the agent person will charge some fee amount also. So here the intermediaries will there, you need to give some fee to that person. This is regular options. So in direct option, though there is no middle person, you may enter, you may buy any unit at any time. But in growth options, you need to have some middle person, so you need to pay some fee also, that middle persons. And growth options, growth option means here focusing on long term capital appreciation, or hoping your fund, your units will grow in value over a time. So like income option means prioritizing consistent income through dividends, interest, enjoying the returns like bites. So if you are biting your cake, you are enjoying. If you are putting that cake in the fridge, you are not enjoying now, you may enjoy later. So growth option means it will for long term. Or income option means you will eat it now itself, that is income options. Now NAV means what? NAV means net asset value. This is per person, per along with ownership, who is the person will be there now, that person how much they will get. Here firstly we need to know investment funds life cycle. Firstly, understanding the life cycle of different investment funds, like that mutual fund, private equity funds, or hedge funds will be required. For mutual funds, we have first they need to formation. Here the in the formation period, the companies, mutual fund companies raise capital from investor by issuing the shares, establishing the fund size, and investment will mandate. So they will format, they will register as a trust or some companies, or they will register and they will raise capital from investors, and they will issue shares, and they will establish one fund size and investment mandate. Next, after that, deployment. Here the fund manager invest the capital in portfolio of assets aligned with the fund strategy. For example, he may go with the growth plan, or he may go with the income plan. You may go with the sector specific. Means we have seen that growth plan means it is long term perspective. Income means they will always try to give their dividends, interest whenever they receive. Sector specific means go with the real estate, REIT, or InvIT. Some they will focus on some sectors. Next, operations. In operation period, the fund continuously manages its portfolio, that is buying and selling assets and paying dividends or distribution to investors based on the performance. So they will start formation, and they will deploy the deployment, and after that operations, and after that maturity and closure. In the maturity, typically these mutual funds means open-ended funds, so investors can buy and sell shares at any time. However, some mutual funds have some predefined lifespan and automatically liquidate upon maturity. So some mutual funds will come into 5 years or 10 years. They may have, they may want to continue, they can continue, because it is open-ended funds, they do not have much restrictions. They need to inform to regulatory. That's it. Closure. In rare cases, an underperforming mutual funds may merge with another funds, or liquidate, or returning remaining assets to investors after the expenses. So some underperforming assets may at the time of close the mutual funds, or they may merge with another fund, or they may repay, or they will give back their assets to investors who have invested. That is mutual fund cases. Next, after that, private equity. In private equity, they will fundraising, that is private equity firms raise capital from limited pool of institutional investors. So they do not raise more money, they will raise more money, but less number of persons. In mutual funds, they may have more members. So even if you have 500 rupees, you can invest in mutual funds. But in private equity, that option will be not there. So private equity firms raises capital from limited pool of institutional investors, or that high net worth persons who are the persons have more money, they will focus on that person's example pension funds or sovereign wealth funds. For example, for a fixed period, they will typically go for 5 to 10 years. They will not have less time, so they will invest. Fund will identify and acquire target companies which have high growth potential and undervalued assets using the raised capital. So they will invest, identify the target companies which have highly potential and which have under assets. They will raise capital, and after that they will value creation. These private equity firms normally they will create the value too, and they will actively work with the acquired companies or implementing operational improvements and strategic changes to enhance their changes. So always work with the in increasing their wealth and their investors wealth. Next, they will exist, means after achieving some desired return, the PE firms exit the investment through an IPO. So they may go with the IPO. Investment strategies may exist through IPO or sale to another buyers or recapitalization or dividend distribution profits to investors, or some cases it may also go for liquidations. Sometimes upon reaching the fund end date, all remaining assets are sold and proceeds are distributed to investors after whatever the fee and expenses will be considering. Next, the after the private equity funds, hedge funds will be there. Hedge funds are similar to private equity funds, but hedge funds will raise capital from limited pool of sophisticated investors who want to take more risk and who are expecting high returns. So they will focus on that person and invest in specific strategies, that is global macro strategies or arbitrage strategy. Example, so trading here, hedge funds actively traded across various asset classes, for example stocks, bonds, derivatives. So utilizing leverage and short selling strategies to generate returns regardless of market direction. So next, performance fee. Here mutual funds often charge performance fee based on the profit generated above high water mark. So high water mark, if the fund was the person who is the manager is there na, that general partner who is providing more services actively working, if the fund is provided more than high water mark, means high water mark means previously peak of NAV. So NAV which is reach high position, that high position is known as high water mark. So if the fund has reached or above the high water mark, then you will get the performance fee. Incentive we gain active management, after that redemption. So unlikely mutual funds, investors redemption are generally restricted in hedge funds, so providing fund manager with greater flexibility in their investment strategy. So in invest mutual funds they have more regulated, because they are involved retail investors, more persons will be there, but in hedge funds less members will be there. They do not regulations, more regulations will not be there in hedge funds, so that they have flexibility to invest in anywhere. And the termination will be, hedge funds can be terminated due to some poor performance. If the performance is poor or the investors redemption exceeding the threshold or reaching the predetermined end date, they will terminate. Now what is the main differentiation for this one? One is liquidity, whereas mutual funds offer the high liquidity, whereas while PE and hedge funds are illiquid, so with restricted investor entity and exit options. Next, investment horizon. Mutual funds typically have indefinite lifetime, while PE and hedge funds they may fix investment period. They must fix the private equity funds, they must fix the paid investment period. And fees, where compared to mutual funds, charge ongoing management fee will be there in mutual funds, but whereas PE and hedge funds will charge performance fee in addition to that management fee. Target investors, here mutual fund will available to that retail investors, salaried employees, retirement persons, so they will focus on that person. Whereas its private equity or hedge funds are restricted to accredited investors due to their complexity and risk nature. Where comparing to investment fund options, this mutual fund or private equity hedge fund, here we need to know about mutual funds mainly firstly. So mutual funds features are open-ended funds, so buy and sell shares anytime through market directly from the fund, and they have diverse portfolios. They do not put all your money in one share, so means it is like as don't put all eggs in one basket. They will follow that concept. So in the year invest in a mix of assets like stocks, bonds and real estates. And professional management, fund managers handle investment decisions and portfolio allocations. They will also charge low management fee with a small capital will also available. So even if you have 500 rupees, even if you have 1000 rupees, they will allow to investments. Here the advantages will be liquidity will be there. It is easy to enter and easy to exit, and they will offer the flexibility, and diversification will be there, reducing the risk by spreading investment across asset classes, and portfolio expertise will be there, leverage the knowledge and skills of fund managers. So who will maintain the fund, which must have the professional persons which have more knowledge in the mutual fund, and they will charge lower fees. Typically this charge ongoing management fee generally lower than the PE and hedge fund. Then PE and hedge fund they will charge that performance fee also. Next, disadvantages. Here limited return potential, can be less profitable than private equity or hedge fund due to conservative investment strategies. They have less control. Investors have limited influence on investment decisions. Market fluctuations, so performance depends on market movements, leading to potential losses. Here the purposes. So after that, here the mutual fund purpose will be provide the broad market exposure and long-term wealth accumulation for retail investors with moderate risk, so they do not take the more risk. And whereas private equity funds, so private equity funds means it features for closely ended funds which have limited pool of accredited investors with fixed lock-up period, that is 5 to 10 years, and high minimum investment will be there, required significant capital will be there, and typically not accessible to retail investors, and focus on illiquid assets. This is invest in non-publicly traded companies or distressed asset with high growth potential. For example, if you see, I think that Lalita Jewelries, that person was taken company which is distressed. So but this mutual funds means fund houses will focus on that type of companies which will grow in long term, so they will focus on that type of assets and achieve involvement. The PE firms actively manage and improve the acquired companies for value creation. Here the advantages will be highly potential returns will be there. They will generate high return than mutual fund because they have targeted investment and they have value creation strategies and control over investments. Here investors have more influence on target selection and investment strategy compared to mutual fund. Access to exclusive opportunities, so invest in non-publicly traded companies with significant growth potential unavailable to broader market, so they will see internally which do not have the publicly available. So if you are not in a publicly available, if you are no or no to other person, then we do not have the more demand and supply. So when do not have the demand, you do not have the more price. So that type of marketed, the type of securities they will identify, they will invest in that fund. After that they will provide the advertisement, they will increase the demand and they will get the profits. And higher risk in investment will carry higher risk due to illiquid and potential for company failure, and they will charge higher fee, charge performance fee also known as carried interest, in addition to management fee that increasing the total cost. Here purpose will be generating the higher return for accredited investors with a substantial capital and high risk tolerance through active involvement in non-publicly traded companies. Whereas hedge funds means it is high diversity strategies which utilize various complex trading strategies across asset classes like stocks, bonds, derivative, currencies. It will go any asset. They do not have the restriction to invest in this type of assets, so they may invest in any assets. So they may also go for leverage and short selling, that is can simply amplify potential return using the borrowed capital, and short selling assets deemed like to decline. And when they have performance fee. They primarily charge performance fee on profit generated, incentive, active management, high minimum investment. Similarly, this PE fund which requires significant capital and are restricted to only those accredited investors, not involved this retail investor mentality persons. Advantages here potentially for higher returns. So employ aggressive strategy for return, potentially exceeding traditional markets. So access to alternative investments, offer exposure to unique and complex investment opportunities, and experienced managers. Here the persons who have expertise knowledge in navigating the market complexity. So here the skilled professional persons will be exist in hedge funds. And disadvantages, so here high risk will be there, complex strategies and leverage amplify the potential loss as well as gain. High fee, they will charge more fee, significantly increase to total cost in year with low returns. And lack of transparency, so strategies can be obscure, that is making difficult for the investor to fully understand the fund operations. It is not easy to understand that hedge fund operations. Their purpose will be generate superior return for sophisticated investors with significant capital and high risk tolerance through aggressive and complex investment strategies. So here the key differences also we are discussed already. After that we have we need to see about relating to one example. Here the fund will be there, Hari fund will be there. Here navigating the market waters. So first setting soil, that is fund formation. So at the time of fund formation, for example, you deposited $1,000 into Hari fund. So Hari fund will be there and you are deposited into $1,000 into fund, increasing their cash position, so your ownership stake. So this will recorded as like debit Hari fund share capital account debit to cash account, because your investment in Hari fund share capital to cash. Debit what comes in, credit what goes out. So cash is going out and you are invested in Hari fund share capital. Next after that investment activity, that is Hari the captain for that Hari fund. So the fund manager with the captain invest in diversified holdings that like technology gains or renewable energy leaders or blue chip stocks. So in they get money from these investors now they will record like Hari fund investment debit to cash account. Next here they in Hari fund investments, so they will record investment account debit to cash. So they will invest in different companies. Now here the Hari portfolio companies will be there, means one will be the captain and after that portfolio means different companies. If you are invested in different companies, it will known as portfolio. From that portfolio companies you got some dividends, or if you are getting any amounts, or if you are getting any stock price increasing, this will boost to Hari's fund income. Then the entries will be fund investment, Hari fund investment account debit to dividend income. So dividend income is the income, so we need to credit in profit and loss account. Here fund investment will be increased. Now maintaining this, they will record some expenses for expenses recording. So Hari fund will incur some expenses, that is $8 in management fee. This will record as management fee account debit to Hari fund accrued payable. So they will enter the accrual entry first and after that checking the map valuation and NAV calculation. So they will calculate the NAV calculation. Here the enhancing the several value for several Hari holding and raising your total Hari shares value. So the accounting will be, so when it is increasing, then we need to increase our fund investment. So Hari fund investment account debit to unrealized gain. And then if you are sharing the treasurers, means you are distributing your profits zone, the fund Hari fund is decided to distribute 12% of net income as dividend. Then we need to record our fund retained earnings will decrease. Now fund dividend payable, Hari fund dividend payable account debit to retained earnings entry will be there. Or if you receive $12 dollars, means you are the person. So fund he is paying, Hari fund he is paying. Now you are receiving that amount, dividend amounts. So you receive $12 in dividend from your Hari investments. So you need to record Hari fund dividend payable debit to cash account. Now bonus. If you choose to sell some Hari shares, the sale amount would be credited to your cash account and debited from Hari fund share capital account. So credited to your cash account and debited to your Hari fund share account. Now Hari fund journal entries. So Hari fund journal, here some additional journal entries will be there for exploring the financial transactions. So for example, investment expenses will be there. So expenses means you need to debit investment expenses account debit to cash. Here the recording the expenses related to buying or selling portfolio assets, brokerage fee, transaction expenses, STT, any other expenses, whatever the expenses, you need to record investment expenses account debit to cash. And if you are getting any incomes, means incomes, interest incomes, that is interest income credit, cash account will be debited. Here you need to capture the income earned from holding the bonds or other fixed income assets, etc. And unrealized loss, sometimes you need to record mark to market, that is daily settlement will be there. So for the daily settlement or on the date of reporting date, you need to record the, so then you will get the unrealized loss sometimes, and some cases you will get the unrealized gain. So if it is loss, you need to debit, if it is gain, you need to credit. So unrealized loss account debit to Hari fund investment accounts. It will reflect in a decrease in the market value of Hari holdings, potentially offset by other gains in the portfolio. Next, subscription and redemption. If you are subscription and redemption, means cash account will be credited and Hari fund share capital will be debited. So record new investor subscriptions or increasing the Hari's cash and outstanding shares. And whereas Hari fund share capital debit to cash when capture investor redemptions will be there, or decreasing the Hari's share capital and reducing the their cash position. I think it was there different stock splits. So if it is happens stock split, you need to debit fund share capital account debit to stock dividend distributions, and stock split increasing the number of outstanding shares. So without implicating the total shareholder value. So we need to debit share capital and stock dividend distribution we need to record when stock splits is happen. And whereas stock distribution will be credited to Hari fund share capital, distributing to additional shares to your existing shareholders as a result of stock split. So first company will issue to fund house and a fund house to these persons, unit holders. And if you are paying any tax amount, so tax expenses account debit to accrued payable. So that is accrual entry will be there for estimating the tax liability for incomes, capital gains or dividends. Tax will be calculated estimated taxes. Next, accrued payable, that is debited to cash credited when actual payment is there. So first we need to accrue the entry, accrual entry, after that we need to payable entry. Remember here some examples only. Now we will see the private equity life cycle. So we are completed mutual fund life cycle. Now we need to see the private equity capital. Private equity capital means a fund accounting perspective will be in private equity, they will lend fund accounting. Now we need to know some events, thumbs and challenges will be there in fund. So first this private equity will fund rising, that is 1 to 2 years there. How they, here the LP commitment will be there. So if imagine you are a wealth investor, that is LP, investor venture capital is pledging the capital to the fund managed by the general partner. The funds will be there and subscription ledger will be there. So in the fund ledger, fundraising stage, we have commitments will be there and subscription ledger will be there, and that PPM LPA will be there. In subscription ledger we will record the books, funds record the books meticulously, tracking each LP's committed capital. So committed capital means what they promised. These are the persons who are the investors who are promised to contribute, that is committed capital. And we need to see the paid up capital, actually received from the investor, it will be paid in capital. So committed capital means what they promised and paid in capital means actual cash received. Now PPM, LPA. PPM means that is private placement memorandum. It is like a prospectus when if your company is going for invest IPO, then they need to provide some advertisement. For advertisement purpose, they will provide prospectus. So red herring prospectus. So same like as that prospectus, we have in fund houses will issue this PPM, that is private placement memorandums, and outlining the fund strategy, fees, what is the fees, what is the terms will be there, and finally negotiated agreements will be provided in limited partnership agreements. The fund legal backbone think investment contacts. This is first stage. After that, investment stage. In investment stage, 1 to 3 years will maybe investment stage. So whatever the funds they are collected out of that commitments, they need to invest na. Here they will deal closings will be there. The general partner will acquire a company, that is portfolio investment. The fund accounting team record the purchase price and initial valuation and impacting the NAV price. Share. Here we need to updating the map with new acquired territory values. So for example, monitoring investments. Now when you are invested, you need to monitor also. So here the team will continuously track portfolio company financials will be there. They will ensure the accurate NAV calculations and performance report for LPs. LPs means these limited partners will be there. And stage 3 will be value creation. So they need to grow what the investor they provided amount na, from that we need to create some value. So that is value creation. So operational expenses will be there. The general partner efforts to improve accrued companies involve expenses. So expenses will be there, record fund ledgers, and potentially leading to some temporary dips in NAV. So NAV, some in this private equity, it has J curve effect. J curve means what? For example, if you see in this the case, J curve means it will start with here, because at the starting stages in private equity they do not have any. So if you see in life cycle, first 1 to 3 years they are collecting only. So after that 1 2 years they will invest in 3, start with 4 to 5 6 7 that later years. So first they in first year, second year also they will charge management fee, so they will have negative. So after that year on year they will increase the funds inflows. So at the end of the fund they will have more inflows. So starting stage they have only cash outflows will be existed. Next, operational expenses. After that, NAVJ effect, think the investment tools and supply. Carried interest accrual. So as in portfolio companies grow in value, the GP, that general partner will be there now. The general partner earns a performance fee, that is carried interest calculated and accrued in fund accounting records. So here the carried interest means incentive fee. To encourage, to motivate that person, they will provide some carried interest. Next, stage 4, here exit strategy. Exit the valuation and gain losses. So when general partner sell portfolio companies, that is exit, the sale price is compared to original valuation, generating gain or loss recorded in the fund accounting. Yeah, think of final selling, the discovered treasury, and calculating the profits. So now we also know about the waterfall distributions. Here waterfall distribution means distributed to LP based on the predetermined waterfall structure. So we have one waterfall structure means first person is this, second person this, third person this, after this person only we will take some amounts. That is waterfall structure, waterfall provision. So profits will be distributed to LP, that is limited, based on the predetermined waterfall structure. So first priority will be carried interest for the general partner and followed by the tiered returns for different LP classes. So imagine the dividing the treasury account according to pre-agreed map, so ensuring everyone get their shares. Now what are the issues and challenges in private equity? First, the valuation complexity. Accurately valuing illiquid portfolio companies can be challenging. So it is not easy to value the illiquid portfolio, and they have more challenges also, and impacting the NAV calculations, and the limited partner will have confident impact. Now thinking the estimates will go, and some fee transference will be there, that is complex fee structure, and carried interest calculation can be opted for LP. So in carried interest only the general partner will receive that incentive fee, that limited partner will not receive any amount. After that carried interest only they will share the profits to limited partners. So next, providing timely and accurate performance report to LP with diverse reporting needs can be complex, requiring robust accounting system and tailored communication strategies. Now, master fund. So some unique structure. So in PE, what is the structure means? The structure will have master funds. So feeder funds. So master funds means the main investment vehicle, where the investment vehicle is registered, where the investment vehicle is started, that is the main investment vehicle is known as master fund, with its own accounting record, with its own financial statements. So it has own. So main ship of logbook. And feeder fund, here the small funds investing in the master funds. So these are the persons. For example, in sea, one Titan ship will be there. This is big ship. So this big ship will not come to this. What we say now? For at least place it will not come, only more water is there, they will stay here only. Some boat notes will be there, small ships will be there, they will carry the goods in the ship and they will load here. This small ship, this boat notes will carry these items into this big ship. This big ship is known as master, and this boat notes, these small ships will known as feeders. So the small funding investing in the master fund often used for geographical diversification or catering to small investors. Here I imagine it has a small boat attached to main ship, so sharing its journey and profits. Next, blocker entity means, here the blocker entity means a separate legal entity used to avoid conflict of interest between different funds managed by the same GPA. Here blocker entry means general partner will be there, and general partner will manage different funds. So to avoid conflicts in that case, he will register another fund, another name, blocker entity, manage the same GP. Think it is has neutral in island where different treasurer maps are kept safe and separate. So if you have in some islands will be coming, so in islands how can we go? So for that island we will take some separate ships, this JP only we will take care. So like that, where how tax free places will be there. So in tax free places they will not have any taxes, or some DTA double taxation agreement will be there, and that some places we will not pay any taxes if the have registered in that places. So that the cases, this blocker entities will be registered in that places. So we will get that benefit of tax free or DTA benefits. That is blocker entity. It is like as main fund only. This does not have same like as main fund only. They will register because to get the benefit of that local area. Next, parallel funds. Similarly, fund will rise simultaneously by same GP, potentially with different investment focus or terms. So I have focusing on real estate. So we are registered in PPM real estate only. So LP also our objective will be real estate only. Now I have knowledge and invite, that is infrastructure funds. We have knowledge, now we want to invest in that infrastructure also, that similar funds they will raise the same GP, and potentially different focus will be there and different terms will be there. So then at that time we will run another fund parallelly to this master fund. Here They have multiple ships sailing under the same captain, exploring different territories. That market will be customized goal. And vintage year means in the accounting terms we have calendar year and we have financial year and vintage year. Vintage year means this mark the year the fund is launched, used for benchmarking performance comparison with other funds. Here cash flows in private equity. What is there in cash flows in private equity? Cash flows, how the cash flows will go into private equity. In private equity cash flows will be like a life blood of any investment. So if your body, how the blood is flowing, the cash flows will be flowing like in private equity also, and there is no exceptions. Here the how cash flows will be there. Here source of cash in private equity, firstly the limited partners, commitments will be there. The limited partner commitment will be there. So the investors will contribute the capital to the funds over a specified period, and creating the initial pool of investment capital means they do not pay immediately, or the fund houses will not collect immediately full amount, because they will just a second here, I have some doubt whether I have on the mic or not. I am getting the doubt now, so we will continue. Just give me 1 minute. Okay, I have launched. Come back. Okay, means what we are discussing, sources of cash. So what is the source will be there? So first source will be commitment. So commitment means what? They promise this amount, so I will promising this amount, so I am giving the oath I will give this money. So they will promise, no? That promised amount means known as commitment amount. So whatever the commitment amount there, and they will contribute 25% first year, 30% second year, and 30% second year. That different year they will invest, they will give, they will contribute. So it will create the pool of investment capital. Now carry accruals. So these partners who is a portfolio companies will grow and eventually sold. The general partner will earn performance fee. It is carried interest. So based on the gains, the fees will be accrued over time and becomes a source of cash when it is realized. Only on realized profits only the GP will take the incentive fee. Otherwise, general realized profit he will not get the fees. So in case of hedge funds, even though realized profits or unrealized profits, he may take incentive fee, but in private equity it does not have that option. Only on realized profits only he will take. So up to that he need to accrue, the entries will be recorded. And debt financing. Here debt financing, some PE funds utilize leverage, borrowing money to amplify their investment capacity. So debt repayment and interest payment contribute to the cash flow. So money management fee will be there. Fund charge limited partner ongoing management fee. Management fee means similarly same as they are managing the fund, so that they will collect some fees amount, that is known as management fee. So fund will charge limited partner ongoing management fee, typically percentage of committed capital, because they will not on NAV. In mutual funds on basis of NAV they will calculate, but in private equity the NAV may be zero for first 1 year or 2 years, because they do not how the capital they may commit, and they will not collect full amount at the starting itself. So maybe it will be NAV calculation is not good, so they will go with the committed capital. So on the committed capital they will charge the management fee, and persistently they have different types will be there for calculation of fees. That switch method is there, and NAV method is there, committed on committed capital will be there. So different methods will be there, where based on that they will charge the management fee. Challenging in collecting the cash, so because this is illiquid illiquid will be there. Unlikely publicly traded assets, that is investment in PE funds are illiquid, and lock for funds lifespan will be 5 to 10 years. So this will make it challenging to access cash quickly, even if the fund if it needed. So portfolio companies performance, for the purpose of cash flow dependence heavily on the performance of the acquired company. So how they will invest in companies like startups, acquired companies, based on that acquired company's performance it will depend the cash flow. So delay in exits is there, operational challenges is there, or unforeseen economic downturns can be significantly impact the cash generation. Next, now call capital notice. Call capital notice means what? Here the investors will committed na, for that committed they will not give full amount at the time of initial itself. So if the additional funds is needed, this fund house, the general partner may issue call capital notice to limited partners and requiring them to contribute more capital than initially committed. So what they committed initially, they will ask that amount, and this can be distributive and creative cash flow strength for limited partners. And fees and expenses, here management fee will be there and incentive fee will be there, and operating expenses will be consumed portion of some cash flows, impacting the amount available for distribution to limited partners. And here cash flow processing, how it will process. In cash flow processing means that escrow account will be there. Escrow account means the investor subscription and capital cost are often directly to escrow account, ensuring secure handling of funds before deployment. So some cases this fund houses maintain separate account, they will not utilize it immediately. They, by utilizing that amount, they need to satisfy some terms and conditions. So up to satisfying of the terms and conditions, the money will be kept in separate account. That account is known as escrow account. Next, subscription line of credit. Some funds utilize credit facility to bridge the gap between limited partner commitment and actual cash receipts, so smoothing out of the cash flow. So next, distribution waterfall. Here waterfall distribution, that is profits are distributed to limited partner based on the predetermined waterfall structure, or prioritizing the carried interest means first priority will be carried interest will be there for the GP, and then tied return will be for different LPs. So for example, what is the amount realized amount we will see. Firstly they will try to repay that whatever the principal is there. After that we will go with the preferred return. After that preferred return, catch up will be there. After that catch up, then they will share the profit to LP or GP. Maybe here the ratio will be 80:20. So here prefer return and catch up will be general partner share. So priority will be given to that only firstly. And monitoring and reporting, cash flows are is consistently and monitored and reported to LP, providing transparency and insight into the fund financial health. So here we need to know about this. Now we are discussing about PPM and LPA, that is private placement memorandum. PPM means, and LPA means limited partnership agreement. Here both crucial documents will be used in private investment offering, but they serve different purpose and contain some distinct contents will be there. Now we need to know what are the contents will be there in PPM and what are the contents will be there in LPA. In PPM, private placement, they have summary of offering terms, so they will give the terms. This section outline the basic details of investment, including the type of security being offered and offering price, minimum investment amount will be required, and target rise will be there, how much they are ranking, and what is the risk factor. Means a comprehensive discussion about the potential risk associated with the investment, and including the market factor and operational risks and management risks. So what are the risks will be there, and they will also disclose that in private placement memorandum. And the estimated use of proceeds or expenses disclosure, so how they utilize the proceeds, what are they arise from the this one. Details how the rise the funds will be used, or often with breakdown of allocation percentage for different expenses and investment activities. And description of securities, so explain the rights and obligations of investors, including voting right, distributions and redemption options. Now business management and sections, this section introduces the business strategy or management teams and their experience. These all items will be included in PPM. And financial information, that is historical financial information, what are the projects taken in previously, how they realized, how they terminated, how they liquidated. They will provide all the past history of that fund house. And legal disclosures and disclaimers, that is important legal information and disclaimers will be provided in this ppm. Now limited partnership agreement, LPA, means it is formation and government. This is the final document. So the ppm means it is draft and LPA means finalized. In formation and government, define partnership structure. This will define partnership structure and including the roles and responsibilities of general partner and limited partner. What is the capital contribution and how they distribute, so specific how capital contributions will be made to limited partner and profits and loss will be distributed, and transferability of interest, so outline the rules of for transferring partnership interest. If any partner want to transfer their partnership interest, they may transfer. How they transferring, if there any fee or is there any terms and conditions, they will discuss about there. And management and voting rights, so defining the decision making process within the partnership, including the voting rights and procedure for meetings. And dissolution and termination, here establishes the conditions under which partnership can dissolve and how assets will be distributed. So they will provide the conditions relating to partnership and how they dissolve and how the assets will be distributed. And dispute resolution, so establish the mechanism for resolving disputes between partners. So miscellaneous provisions will be there. For additional provisions may be addressed topic like confidentiality, indemnification and expenses. This is main cases. And source of cashes, so we have seen the source will be there now. From source will means here first LP commitment will be there. For example, LP commitment, say here we are providing some examples. So LP commitment means, for example, a venture capital fund raises $100 million from LP, that is limited partners, providing the initial capital pool from investments. Next, a carry accrual, so carry accrual means a buyout fund turns around a struggling company and sell it for a profit, so earning GP 20% carried interest, generating significant cash inflows. Next, debt financing, so example, a real estate PE fund secures $50 million loan to expand its portfolio, increasing investment capacity and contributing to cash flow through debt repayment. After that, management fee, for example, a PE funds with 500 millions in committed capital, they will charge 2% annual management fee and generate $10 million in recurring expenses for operations and cash flows. Challenging in collecting cash, so what are the challenges will be there in collecting cash? See, because illiquid assets, so they will go with the illiquid asset now. For example, investors in growth equity fund faces personal emergency but cannot withdraw the capital due to fund lock-in period will be there. They will given lock-in period 5 to 10 years, so highlighting the illiquid nature in PE investment. And portfolio company delays, so a PE funds anticipated, for example, a PE funds anticipated exist in delayed by regulatory hurdles will be there, postponing the expected cash flows and potentially impacting the overall performance. And capital cost challenges, some cases a distressed debt funds faces unexpected legal costs and issue capital calls to limited partners, so demanding additional contribution which can strain limited partner cash flows will be there. And fee burdens, so fee burden means, here example, a PE fund with high fee faces scrutiny from limited partners concerned about the impact of net returns or underscoring the need to balance fee with performance. Next, cash flow processing means, cash flow processing in some cases we have discussed that escrow account subscription. In escrow account, for example, a PE fund safeguards investor subscription in an escrow account, so we have told that a separate bank account will be there up to some terms and conditions satisfaction, then only they will use that amount. Up to that amount will be kept in separate bank account, it is known as escrow account. And subscription line of credit, a PE fund closes below its target but utilizes a subscription line of credit to bridge the gap, enabling the timely investment. So they will, for investors may give money at the time within time or not, so they will go with this cases, so they will take this option. And profit distribution waterfall, here PE funds exist a successful investment, they will generate return 3x returns or 4x returns, and this GP receive their 20% carried interest first and followed by tiered distribution to LP. So firstly they will see preferred return, catch up and the profit share. So first sharing they will see up to 20% they will reduce, after that LP sharing will be discussed. And after that, transparency and reporting, here PE funds provides that quarterly reports to limited partners and detailing their cash flows and portfolio performance and projections and fostering transparency and trust. So we need to manage the cash flows. Here are some examples of some commitment means what, capital call means what, distribution means, J curve means what in private equity. So here commitment means what? So commitment means a legal binding agreement by an investor, that is limited partner, to contribute a specific amount of capital to private equity funds over a defined period. So they will give some commitment, he will committed to pay some amount to the fund, so for certain period of time. So they will commitment, there is a legal binding agreement between the limited partner and fund houses. For example, a pension fund commits 200 millions to venture capital funding, means they have promised they will pay 200 millions to the venture capital fund. Here the meaning means they are obligated to provide up to 20 million when called up. So whenever the venture capital is called to money, then this pension fund will give the amount. So they will not collect the full amount single point of time, they may collect 30% first year and next 40% and next 30% they will collect based on the investment strategy. They will collect the PE funds. After that, example, next fund size means what? Fund size means here the total amount of capital that PE fund aims to raise from investors are representing its investment capacities. So for example, if we see a buyout fund target fund size will be $500 million. So meaning it seeks to gather 500 millions in commitment from limited partners. So limited partner, how much they committed, it will become the commitment amount na, that total commitment from total limited partners, it will become the fund size. And capital call, so capital call means a formal request from the fund manager to investor to contribute a portion of their committed capital, typically fund specific investment or cover expenses. So what we have told, so for 30% first year, second year 20%, third year 40%, they will give some percentage now. So first percentage they will at the initial they will collect. After that the 30% or 40%, for that 30% or 40% they will call, they will give some notice, they will give some letter, that letter is known as capital call. So typically fund specific investment or cover expenses. For example, a real estate fund identify a promising property, issue capital call to LPs requesting 20% of their commitment to finance the acquisition, and that is capital call. And capital call notice means here it will be written notification sent to investor detailing the amount of capital required, the deadline for payment. They will give within 15 days you need to pay that amount, we are investing this amount, we are incurring this expense. They will give the details in that notice. Capital call means they will request and the written confirmation, written notification will be there. For example, an investor received capital call notice stating they need to provide $5 million within 15 business days, so along with wire transfer instructions. Next, here distribution means a payout of profit or proceeds to investors from fund, typically following successful exit from portfolio companies or other income generating events. Here distribution means whatever the fund house receiving, they will distribute the profits to their investors, that is distribution. Here from portfolio company they will get incomes, dividends, they will distribute to investors. For example, a growth equity fund exists an investment at significant gain and distribute a portion of profit to its limited partner based on their ownership stake. Means here also they will give distribution notice, that is a formal notification to investors informing them of the amount of distribution they will receive and payment date. So for example, an investor received distribution notice stating that they will receive $1 million in profits within 30 days, means within 30 days they will send the amount to your bank. Some cases they will not give the amount, they will give in a kind. So distribution in kind, here the distribution of assets such as equity in portfolio company has opposed to cash, so often used while when liquidating assets or distributing liquid holdings. For example, a distressed debt fund will be there, so distributed shares to is restructured company to its limited partner instead of cash. So they will not give the cash here. So instead of cash, they will give the shares. This is payment in kind. Here allowing them to potential benefit from future growth. Recallable distribution means a distribution that a fund manager may require investors to return under certain circumstances, such as to cover unexpected liabilities or losses. So recallable distribution means when the distribution the fund manager require to investors to return under certain circumstances, so such as to cover unexpected liabilities or losses. So distribution that fund manager may require investor to return under. For example, a venture capital fund faces some legal disputes, then they will call back certain portion of previous distribution to cover legal distributions. So legal costs, so fund houses is incurring some legal costs, they will recall from their persons. Or some unfunded commitment means the portion of an investor's commitment. So whatever the amount I have committed, that is commitment amount. The portion of investor's commitment that has not yet been called by the fund manager. So 100 millions I have committed. Out of the 100 billions I have paid to fund house 60 millions I have paid. 40 million I have not yet paid, and they also not yet called. So that not yet called amount or not yet paid amount is there na, that 40 millions, that will be known as unfunded commitment. Here the portion of a investor's commitment that has not yet been called by the fund manager, representing a potential future cash obligation. It will have future cash obligation to the LP, is known as unfunded commitment. An investor, for example, investor has 110 million commitment, out of which 5 million has been called, and leaving 5 million unfunded commitment. Next, after that, J curve means a visually representation of typical performance pattern of private equity funds. So private equity funds have some pattern, so that pattern will be represented in a graphical way. This J curve will be utilized. Here the characteristics of initially the J curve. Here we see, for example, it is the curve, it is the on, and here it will start with here. So J curve, which has negative returns followed by recover and eventually positive returns. So at the end it may go for high returns, but starting it have low, they do not have returns also, negative returns only. Here we are occurring management fee, incentive fee, performance fee, they will incur catch up fee. So registration expenses or some expenses, all expenses will be there first 1 year, 2 year. After the investment they will get capital appreciation income, dividends, rental income. So after the certain period of time they will get, so up to that they will have only expenses, means it will start with negative returns and it will end with high returns. Initially they have negative return followed by recover and eventually positive returns, resembling the shape of the letter J. For example, a buyout fund experienced initially losses due to some setup cost, early stage investment, but eventually generate returns as portfolio company mature and are sold, creating the J curve pattern. Next, now private equity fees and distribution structure, how they distribute the expense fee amount, how what are the expenses will be there, what are the fees will be there. For example, here management fee. So in mutual fund also we will discuss about management fee, and in private equity also we need to discuss about mutual management fee. Here management fee means that fixed annual fee charged by fund manager to cover operational expenses. Typically it may be 1 to 2% on committed capital. In mutual fund it may be 1 to 2% on NAV. They will on NAV. Here they will go with the committed capital. For example, a PE fund with $1 billion will be there. It is committed capital and it will charge 2% on annual management, means they generate 20 million in recurring revenue for operations. The fund houses, it will become a revenue. That partner, it will become the expenses. Next, incentive fee. Incentive fee also known as carried interest. Incentive fee also known as performance fee. Incentive also known as preferred returns. So a performance based fee awarded to general partner, whom to it will give, it will provided to general partners. Typically it may be 20% of profit which is exceeding the predetermined hurdle rate. This is the case. So hurdle rate, here the one concept will be arise, hurdle rate. So hurdle rate also we have different hurdle rates. One is hard hurdle rate and one is soft hurdle rate. Here hurdle rate means what? Hurdle rate means it is like a benchmark rate which the, for example, fund houses is given, I am the investor, I have given 1 million to fund house, and out of that 1 million they have invested in some companies, they got the return of 6%. On that 6%, this general partner is asking, sir, I want incentive fee. So then you will tell, if the amount 1 million is given to bank, they will give minimum 7% return and they will not charge any amount out of this, only this bank charges. This may be also in negligible amount will be there for that bank charges, but you are asking, you are giving less interest than bank interest or that benchmark return. Other than that, you are asking incentive fee, they will score like anything, so that they will give the incentive fee only the hurdle rate, that is they will predefine some hurdle rate. In the LPA they will decide that rate also, hurdle rate will be this rate, above this rate only we will get the incentive fee or performance fee. Then only the performance fee is why they will, it will motivate the fund manager, they will get the more return. Here he is getting less returns, what is the purpose of giving this amount na? So performance is not there, why will you give the performance fee? So that performance they will give one hurdle rate, that hurdle rate, if the hurdle rate is exceeding, then the investor, the in fund investors who are invested, they will get more profits, out of that profit they will give. So without giving benchmark return, he will not eligible to performance fee. That is the case in with there in hurdle rate. We will discuss, oh, don't worry, hurdle rate means what, hard hurdle rate, soft hurdle rate will be there, we will discuss, don't worry. Next, waterfall provision. Here waterfall provision, so here example, buyout fund exists company for 2x returns exceeding the 8% hurdle rate. The general partner earns 20% carried interest on profit above the hurdle rate. So here they have hurdle rate will be 2%, 8%. So above the hurdle rate, if the general partner generate the profit, then only he will receive the this performance fee on profits above the hurdle amounting to 20%. So whatever the amount will be there. Now we will see the waterfall provision. Here waterfall provision means it will define order, it will define the order, it will define the portion of which profits are distributed between general partner and limited partner, often tier based on specific return thresholds. They have preferred return percentage, they have catch up percentage, they have sharing percentage. So which pattern or which proportion, which order they will define based on this waterfall provisions, then specific some returns. For example, they have American waterfall prioritized that limited partner until they receive all invested capital. So whatever the amount is invested na this limited partner, so up to that he will get that limited partner and the preferred return, then GP receive their carried interest on remaining profits. So after the getting of the investment amount, he will receive the amount. And now we will see the hurdle rate means what. Hurdle rate means the minimum target return. So it is minimum target return that LP export before the general partner earn their carried interest. So if general partner is asking carried interest, when if you want that carried interest, you need to generate profits or incomes above the hurdle rate, then only you will get the performance fee. This is minimum target return. And after that, for example, if you see a venture capital fund is set at 10% middle rate, if the investment returns is 12%, then the LP receives all return up to 10%, then the GP earns carried interest on remaining 2% of profits. So hurdle rate is 10%, he generated 12%, means 10 minus 12 it will become 2, on the to he will get the profit. Soft hurdle rate means what? Soft hurdle rate means here the hurdle rate with a catch up provision, that is allowing the general partner to earn some carried interest. So here to earn some carried interest even if the overall fund return falls short of the full hurdle. For example, a distressed debt fund is there that set 8% soft hurdle rate with 50% catch up. So if the fund returns 6%, then LP receives all returns, then GP earns 50% of remaining 2%, so up to full hurdle rate. Now we need to see on American waterfall provision and European waterfall provision. Here American waterfall provision means explanation, it will be limited partner receive all returned capital and preferred return first. Then the GP received carried interest on the remaining partner profits. It is American waterfall provision. For example, refer example 3 for American waterfall illustration. European waterfall, here profits are split proportionally between limited partner and general partner based on their ownership stake until the limited partner receive their full invested capital. The preferred return will not be given to general partner. Then the GP receive their full carried interest on remaining profits only after full invested capital is given to their limited partners. And here example, for example, a real estate fund has 70% LP ownership and 30% GP ownership with 10% preferred return, and profits are split to 10:30. So until the limited partner receives 100% of their capital and the 10% preferred return, the GP receives their full 20% carried interest on the remaining profits. Up to that he will not receive any amount. Next, carried interest, preferred return. Here preferred return means a fixed annual return, that is LP are entitled to before the GP and their carried interest. Typically it may be 6 to 8%. So for example, preferred return means after the it is hurdle rate. So whatever the amount they are generating now, on that you will prefer some amount if the hurdle rate it is crossed on the above hurdle rate. Now what is mean by catch up provision? Catch up provision means allow the general partner to recoup some previously missed carried interest if fund subsequently performs well in later year. For example, if you see principal amount is there, on that principal amount, so fund has earned some cash. So cash was earned, for example 1000 it was earned, up to principal means they are invested 500. So we will remove that 500. Now it will be 500. On that 500 we will go with prefer return, and after that here they have catch up. After that catch up, share will be there. Here share will be 80:20. This is for GP, this is for LP. This is the order they may go with this. If any missed amount in preferred return, you will get in catch up. So this also included in that LPA agreement. Profits will be share and profits. Here for example, profit share means after that catch up you have profit sharing now. Here less common performance based fee where GP and LP share profits above the specific threshold in the predetermined proportion. For example, a growth equity fund sets 15% profit shareholding. So profit share threshold will be 15% if the fund returns 20%. So here fund has certain 15% profits and fund returns 20%. The LP will receive 85% of the profits above the 15%. So they set the profit share 15% now. 15%. Now fund returns have 20%. Now 85%. Now out of that 85% means above the 15% means 5%. on that he will get limited partner, and GP receive 15% of the profits above 15%. Now clawback provision means a provision allowing the GP to reclaim previously distributed carried interest if the fund performance later deteriorates significantly. For example, we have discussed two. One is catch up, one is clawback. Catch up means it will give more, so it is giving more. Clawback means get back whatever the you are giving more na, get back that amount, so reclaim amount. For example, the fund house paid more amount to this general partner, now it will recall back from that person, reclaiming previously distributed carried interest in the fund performance later deteriorate significantly. For example, a buyout found carried interest on an overvalued exit, but the company subsequently faces legal issues and significantly declines in the value. Now, clawback provision may allow the limited partner to recoup some previously distributed carried interest from the general partner. It is relating to private equity. Now, what are the roles of general partner and this limited partner? General partner means the fund manager responsible for investment decisions and portfolio management and overall fund performance. So general partner means who is the person, fund manager, who will responsible for investment decisions and portfolio management and overall fund performance. They will raise the capital from limited partner and invest in companies and strive to generate returns exceeding the hurdle rate. So if the fund performs good, if we get the amounts exceeding the hurdle rate, then he will receive amounts, generate returns. Here the limited partner is the persons who have passive investors providing capital to the fund, so they will give capital to the fund and they rely on the general partner's expertise and receive returns based on the fund performance. So however the fund is performing, based on that fund performance they will get the amount, but have limited involvement in day-to-day operations. Now we need to know some financial consideration here, that is fee. How the fee will be there for GP and LP. For fee, general partner receive management fee, that is it may be 1 or 2% of committed capital to cover the operational cost, and he will also get the performance fee, that is carried interest based on the exceeding the hurdle rate. If it is exceeding hurdle rate, then he will get the carried interest. And LP does not pay management fee but may incur transaction fee and carried interest payment to general partner if the successfully exist are achieved, so will not get any fees, and it does not pay any management fee but he will incur the transaction fees and carried interest payment to the general partner if successfully exits are achieved. So next, investments. So how the investment? So this general partner invest alongside LPs in certain cases, so aligning their interest and potential sharing in high return through carried interest. So they will invest. LP is the person diversify their portfolio by investing in multiple funds and asset classes, mitigating the risk through passive nature of the investment. He is thinking in a low, means if the person does not require to take more risk, he will go with these cases. What are the benefits and risk will be there to these general partners and limited partners? General partner benefit, potential for significant performance fee if the fund performance well, or control overall investment decisions and potentially co-investment opportunities will be there. Next, risk. Here responsible for fund performance and generating return for limited partners, potentially liability for losses or reputation at stake. So general partner will be potentially significant performance fee will be there, and if he is performed very well, and control the over investment decisions and potentially co-investment opportunity will be there. and risk will be responsible for fund management and generate the returns for investors. So on behalf of limited partner, you need to generate returns, potentially liability for losses, and means here for example losses. Now I will get that, just a second. Means if the LP is committed 50 lakhs, GP is committed 50 lakhs, for example total fund is 100 lakhs, it was invested, and now it was got loss, so loss may be 200. So out of the 200, this is loss, for example this is loss, this loss up to 50, whatever the commitment of limited partner is there na, he will take up to 50 only. Above that 150 general partner will need to incur. Here that general partner loss will be unlimited. Because of this case, you need to incur more loss. Now what they will do for this general partner, they will not go with the individual basis, they will create some limited companies. So limited companies they will establish it, they will act as general partner. These limited companies will act as a general partner for limited capital. For example, this limited capital has 75 crores capital net worth. So now the loss will be 150 crores. But here general partner need to incur. But here the general partner is company now. Then loss will be up to this net worth only, because this is limited partner, limited company, this does not have unlimited liability. So the law will be utilized like this only, because more general partners may be in these companies only. For example, I think so. Now we will see that persons. Who is that? Limited partners, Blackstone, Mumbai, hedge funds, feeder funds, fund housing, custodians, CDSL, SLJ, asset management companies, fund administrators, Indian firms, discount brokers, full service brokers, Noroma, TPG, limited partners, now general partners. So here the general partners will be Sequoia Capital India, that is Selinder Singh, that is individual person, and Abhishek Mukherjee, TPG company related, Advance International, Sandeep Singhal, this is general partners. Some cases, in place of these persons, they will appoint in limited companies, and these limited partners are always have limited to their capital, limited to their commitment. The loss they will not bear whatever the loss. So only to the extent of their commitment only they will bear the loss. Now next, benefits, limited partner benefits. So access to potential higher returns. So exposure to private equity or diversification of benefits or limited liability. Here risks will be liquidity of investment or dependency of general partner exercise or potential for lower risk than other assets. Who will benefit from what? Here from management fee. General partner will benefit directly from management fee regardless of fund performance. So it is not linked to fund performance, because of he is managing the fund, he will get the management fee. Next, after that, carried interest. So both general partner and LP limited partner can benefit from carried interest, but general partner earn significantly larger share, that is typically 20%, after the limited partner receive their preferred return and invested capital back. Next, overall returns. So overall returns, ideally both general partner and limited partner benefit from positive fund performance. Also, the general partner potentially gain through carried interest can be much higher. Next, carried interest. Here, general partner and LP both are benefit, because General partner will earn significantly larger share, typically 20%, after LP receives their preferred returns and invested capital back. Next, overall return. On overall return, both general partner and limited partner benefit from positive fund performance. So although the general partner potentially gain through carried interest can be much higher. Next, if it is downside, ultimately LP bear the brunt of potential loss, but whereas GP may still have receive management fee and sometimes retain some carried interest through clawback provision. So you may need to repay, which we have seen in clawback. So clawback provision means what? If the fund requires any operational expenditure it is not able to meet, then call back from the general partner, that is clawback provisions will be there in LPA agreement. Now buyout will have different investment strategies. So what are the strategies will be there in this private equity? They may have buyout fund. Here focus will be, for example, acquire mature established company with substantially cash flows. So they will focus on, we have already established company, we have more name, more trustworthy company, they will invest in such funds. And for example, KKR acquires Toys R US, that is revamp it online presence and store operations and eventually sell it to another retailer, generating significant return from investors. Next, venture capital. Here invest in early stage high growth startups with disruptive potential, providing seed funding and guidance. So venture capital means these are the persons, initial stage will be there, high growth stage will be there, they will provide seed funding and guidance for 7 to 10 years. They have expertise, knowledge, expert teams will be there in their company. For example, Sequoia Capital invest in Airbnb during its earlier years, fostering its growth and ultimately benefit handsomely from its IPO process. So we are the persons will invest in the startups and they will benefit when they are performing well. Next, they will focus on injecting the capital into rapidly expanding company to fuel their future growth and market share expenses to 3 to 5 years. And for example, General Atlantic invest in Spotify during its growth phase. So that Spotify is there now growth phase and enabling its global expansion and contributing to its eventually public offering. Next, after that means firstly we seen that first investment strategy with buyout funds. So they will go with the established funds, and after that venture capital, that is early starting companies, venture capital. After that growth equity means which is rapidly growing, that is Spotify or this Cuckoo FMs will be there, which is rapidly growing companies, they will invest in that companies, that is growth equity. And distressed debt, here acquiring the debt of which are a company, struggling companies will be there, that struggling companies will sell their company shares at a discount price. So and after that restructuring debt arrangement and turn them around for profits 2 to 4 years. So for example, Oak Tree Capital Management buys distressed debt of a hotel chain during a recession or negotiate debt forgiveness and eventually exit through successful sale. Next, they will may go with the REIT, that is real estate private equity, that is invest in and manage various real estate assets like apartments, warehouse or office buildings, or generating income through rentals or property capital appreciation. For example, this Blackstone acquires a portfolio of logistics facilities or leases them to e-commerce companies and enjoy stable rental income with the potential for future value appreciation. Now this buyout fund means we have expressed now, acquiring matured established company will be there, and venture capital means high growth startups with disruptive potential. Next, after that growth equity means injecting in rapidly growing expanding distressed debt, and real estate, I think it is copy pasted both. Venture capital, real estate means that is invest in and managing income generating real estate assets. They may invest in apartment, warehouse, office buildings. For example, Prolog is a global REIT, own a vast network of logistic facilities leased to e-commerce giant, providing stable return income and potential value appreciation. Also, they may go with the PIPE, that is private investment in public equity. So, this focusing providing private financing to publicly traded companies undergoing transformative phases, often at discount to prevailing market prices. For example, this is example Apollo Global Management participate in PIPE deal with Twitter during its privatization efforts. So gaining access to the company at a favorable price before its eventually acquisition by the Elon Musk. Next, distressed strategy means we are already discussed that which are struggling companies. If there are struggling companies, we will buy that struggling companies at a discount, or restructuring debt arrangement, or turning them around for profits. Next, credit strategy. Here credit strategy means focusing providing various financing solutions to companies like senior debt, mezzanine debt, structured loans, earning fixed interest payments, and potentially capital appreciation. So we are providing financing solution to companies. For example, this Blackstone Credit will offer a range of credit solutions to across industries, from financing the leverage buyers to supporting growth initiatives generating consistent income streams. Next, marine strategies. This marine strategy means investing in maritime related assets like shipping companies or port infrastructure or offshore energy projects, or capitalizing on global trade and resources demands. Next, here example for that Carly Group acquires a portfolio of container shipping vessels, benefiting from rising trade volumes and improving industry dynamics. Next, leverage buyout. LBO. LBO means focusing on acquiring mature or established companies using significant debt financing or restructuring operations and selling them for profits. For example, KKR acquires Toys or US revamps its online presence and stores. So focus means they will focus on established companies. Now here we need to understand real company data means promoting PE firms illustrate the key milestones. So for fund means life cycle, for private equity life cycle, you need to know firstly fund formation. That fund formation, for example, this Blackstone capital partner raises some amount, so 26 billions they are raises from LP limited partner. Now we need to enter that in books of accounts. So fund accountant person means what they need to, they will write the entries for this accounting. So Blackstone capital partner raises $26 billion from limited partner. Now what is the entry here? Cash is coming means when assets are increasing it will be debit, assets are decreasing it will be credit, and oppositely liabilities are increasing it will credit, liabilities are increasing liabilities are decreasing it will be debit, and whereas incomes are increasing it will be credit, incomes are decreasing it will be debits, expenses are increasing it will be debits. Now based on that we need to pass some general entries relating to private equity. Now so we have completed that mutual fund and mutual fund entries. Now we are going seeing private equity and it's relating to expenses entries, general entries. So firstly, when capital partner raises 26 billion from limited partner, now cash account debit to capital commitment 26 billion cash account debit to capital commitment. Next, from they collected cash, now they will invest in different strategies, different stages will be there. So when Blackstone acquires ancestor company, so company share will be fired. So they have 26 billion now. Out of that 26 billion they have buy the shares of ancestor company for $4.7 billion. Now we need to pose the entry also, that one also. So investment means it is increasing the asset. So when the asset is increased, debit that. So investment account debit to cash. So we need to pay the cash amount. So 4.7 increases, 4.7 cash decreases. Next, after that, for that they will charge management fee. So Blackstone will charges management fee 2%. That committed capital on committed capital. Now on that committed capital, so whatever the committed capital, on that committed capital 2%. For example, committed cap some amount will be there, the 2% it will become $520 million. Now entry, firstly you need to write amount. It will, for the fund house it will be income, and we need to accrual entry will be need to post. Then accounts receivable account debit to management fee revenue. So it is income, so that we are crediting management fee revenue. In we are accruing the receivable entry. Next, portfolio company performance. Now we are invested in ancestor company now. Now ancestor company EBITDA grows 15% doing the Blackstone's ownership. Now we need to pour the entry. Now we need to pour the entry. We will receive the cap amount from that we are giving, means now debit to what comes in. So cash account debit to investment. So we are invested only 4.7. Now we are getting 705. So we need to credit investments. Cash account debit to investment. Now when we are existing scenario, now Blackstone exists ancestor stone through an IPO with 3xing the returns. Now we are, when we receive amounts we are posted that one. Now we are that IPO is going existing in sister company through an IPO. Now we will get the cash. So cash account debit to investment, and we will need to credit that carried interest revenue. So here we need to see that full amount of carried interest we will get, because we have performed more, we have taken more. So above the hurdle rate we will get the preferred return, that is carried interest. So here we have charged management fee, now we are charging carried interest revenue. After that we need to distribute this to LP, that limited partners is there now, we need to distribute that limited partners. Now Blackstone distributes 80% of realized profits to limited partners. Then general entry will be capital commitment account debit to cash account. This is the entries will be there. Now some another expenses will be there for regular nature, means operating expenditure there, operating incomes will be there, assessment increase. So that expenses, for operating expenses, day-to-day expenses, Blackstone incurs various day-to-day expenses like salaries, rent, technology, traveling. We need to record that one also. So for that, expenses account debit to account payable. First we need to write the accrual entry. After that, Blackstone also pays for performance based incentive to its employees for exceeding the financial targets. So they will pay salaries, they also pay target to who have completed the more. So here compensation expenses account debit to accounts payable, that is incentive fee amount. Then when the Blackstone receive operating income, so generate income from various sources beyond investment gains. This includes management fee charged to PE funds they manage, debit fees account debit to management fee receivable. So management fee revenue whenever they receive the cash, or transaction fee associated with acquisition and exit. So some, when we are investing we need to pay that STT and registration application fee, that expenses will be there. Then we need to pay cash account debit to transaction fee revenue. So it is relating to profit and loss account, we need to post directly that one. And when we have interest amount, cash account debit to interest income, and integrating the some incomes and expenses. So operating expenses and income directly impact Blackstone's net income, which in turn affects the capital contribution to LP. Now some simplified, we will give general overview how can we write this. So general entries for closing income summary. So if you have income summary, net income it is negative, we need to debit. Net income, retained earnings. So for income we are posted that incomes to credited na, the management fee income, incentive fee income, we need to transfer that to retained earnings. So then closing income account debit to retained earnings, this is the n entry will be there. In that cases operating expenses means various expenses will be there, account payable there, and they will pay some compensation means compensation expenses to account payable, and management fee charged cash account debit to, I think it is also double. Now we need to see some master feeder expenses or intergroup company expenses. So when master feeder structure will be there, feeder fund invested in master fund. So what are the feeders means? Feeder means that small ships is there na, small ships. So this is the Titanic ship. So it will not come to that place, end place. It will stay in middle of the sea only. This small ship take this goods and this load into here. This small ship load into here. So this big ship is known as master, and this small ship is known as feeders. Now here the feeders will invest in. So here for this big ship, this are feeders na, this is providing, means they need to write investment account debit to cash account. So master fund units, they are purchasing the cash. Then master fund, here they will receiving na subscription receivable account debit to capital commitment. Now whenever capital call from master fund, they will write cash account debit to subscription receivable. Then feeder fund, they will have commitment. So they have commitment na, for that capital commitment account debit to account payable, they need to pay to master fund, so account payable will be there. And distribution from master, so whenever master get the profits, they will distribute to this feeders. Then distribution payable account debit to NAV, that is net asset value. And feeder fund will have debit, that is received distribution, so cash account debit to distribution payable. So next blocker entity will be there. Blocker entity means what? Some countries they have tax free, just a second. So some countries we have tax free or DTAA exemptions. If they registered in that country, then we will register some entity. It is like as a master fund only. It will act as master fund. Then here also some entries will be there. Blocker entity formation. So for the blocker entity formation, then debit cash account debit to investment in blocker entity. So cash account debit to investment in blocker entity, that is blocker's ownership. Now blocker entity acquires portfolio assets. So if it is acquire means it is asset to them. So asset means investor in blocker entity account debit to cash account. Then when there is existing, then we will receive the proceed from the blocker sale. So cash account debit to investment in blocker entity. Next or we will also get the gain or loss on sale of that blocker sales. Now parallel funds. Parallel funds means here one main fund is there. So it is objective to real estate. Now we have knowledge of infrastructure also. So we do not have the objective term in infrastructure terms in that LPA. We do not have LPA. Now they will to conflict means to avoid the conflict, they will start another fund parallel to master fund. Then they have entries also. So cash account debit to capital commitment. So here capital commitment and cash account debit to capital fund. If you have fund 1, fund 2, fund 3, and they have shared expenses of fund 1 or fund 2, then also management fee expenses account debit to account fee payable, account payable. If you have independent distribution to LP, so they need to distribute to LPs na, distribution payable fund 1 credited to NAV and distribution payable fund 2 credited to NAV. That is the case. Now if there any intercompany transaction, they will also pass the entry fee. For example, management fee there. Management fee, management company provides services to portfolio company, that is debit account receivables, credit management fee, revenue. It is revenue for that fund. And here PC, that is another one, debit management fee expenses, it will become expenses at PC na. And credit account fee payable. And for monitoring and advisory fees. So MC incur some expenses supporting pieces, due diligence, legal expenses. We need to see that debit consulting expenses, or we need to see that affiliates fee. In master feeder structure they will use the affiliates, and these all expenses they don't want to write this management fee payable and due diligence fee, legal expense, they will write as a syndicate expenses. So they will use as a syndicate expense word. So syndicate expenses account debit to cash. So in that syndicate they have whatever the expenses are, that like we use that miscellaneous expenses now. For miscellaneous expenses means this is how this different expenditure will write in this miscellaneous expenses. Same like they will use as with syndicate expenses, that ROC application whatever the expenses will be there, they will write here in this one. And they have co-investment will be there, distribution of waterfall profits was realized, investment valuation will be there, mark to market adjustment, then also they will write some entries. Now we need to see that valuation level 1, level 2, level 3 will be there in cases. So for fund the investment will be valued with market value, that is fair market value. When some this private equity all will go with the illiquid now, some cases they do not have the fair value, so then they will go with the limited level 1, level 2, level 3. Now what is level 1 valuation? Here readily available market price, this readily available market price. Here for example uses readily available market price to value an asset such as publicly traded stocks or bonds. For example, if you want to buy Apple shares, so if you want to buy Apple shares, the share price you may know if you enter into NSE, or you may know if you enter into BSE. So it is actively traded company, it is available amount, so it is easy to know. So share stock exchange will be there, level 1 valuation of your investment, it will be 150. Here the advantages will be simple and transparent. Why the transparent? Because so many buyers will be there and so many sellers will be there, because more persons is there in that market, it will be trusted price and no complex calculation will be needed. And disadvantages here, limited to easily traded assets, does not account for future prospects. Next, level 2 valuation. Here significant observable investment. Here significant observable investments, we do not have active market to that shares. For example, in above example, Apple shares is actively traded because they have market. If that Apple shares does not have market share, we need to see the similar asset which is Samsung company. That is the case. For example, use the observable market data like quoted price of similar assets. So in our example, that Samsung, or valuation models will be used for valuation based on the market data to estimate the fair value. For example, you invest in a private company through crowdfunding platform. You are investing through crowdfunding platform. The platform uses a valuation model based on industry benchmarks and comparable publicly traded companies to determine your investment value. And here the advantages will be more flexible than level 1, can be applied to liquid assets. So to less liquid assets. Disadvantage is relies on assumption and models and less precise than level 1 for readily traded assets. So in level 1 we will get easily, but level 2 we will know which is the similar asset. It is the main task for the investors. If does not, the person does not know which is the similar asset, it is hard to find the price. Next, level 3. Level 3 valuation means unobservable inputs. Here use the significant unobservable inputs. Like means here does not have active market, does not have similar asset. Here we need to go with the some different technique, different assumption, different valuation, different projections we will use. So internal forecast, management estimates to estimate the fair value when no reliable market data is exist. Here you invest in real estate development project. For that real estate project, the developer uses complex model for incorporation construction cost or projected rental income or market condition to estimate the project values. Here advantages can be applied to unique assets without market prices. So this does not have the market price, they have unique nature, hence it will apply to unique nature. But disadvantages will be highly subjective and susceptible to manipulation and require careful analysis will be required and justification will be required. After that we will go with the discounted cash flow. Here discounted cash flow means valuation estimate an asset's present value by discounting its future expected cash flows to their current worth. For example, you are considering investing in a new technology startup. For example, you are analyzing its projected revenue and expenses over the next 5 years. So we will see the whatever the cash flows will come from that investment if we invested in that technology. Now discount them back to present using the appropriate discount rate and arrive at a valuation for the company that is related. And advantages will be here considering the future potential and risk, provide more detailed understanding the asset value drivers. So whenever you are considering the features, it will provide the more understanding, detailed understanding. Now disadvantages. What are the disadvantages? Require complex financial modeling and assumptions and can be sensitive to change in input variables. Now each valuation method have its strength and weaknesses, so most suitable method depends on specific assets and available of information. So combining multiple methods can provide more robust and comprehensive valuations. Now for some other valuation methods also there, so we see that discount cash flow method. After that we have comparable company analysis method. Here this approach will be compare the valuation multiples, that is multiples will be private equity ratios or enterprise value EV to EBITDA. EBITDA means earning before interest, tax, depreciation, amortization. Now of similar company in the same industry or sector to estimate the value of target company. For example, if you are evaluating a private software company by comparing its financial metric means is PE or EV by EBITDA to publicly traded company software with similar business model and growth prospects. And another method will be precedent transaction analysis, PT analysis. Here analyze the price paid for similar asset or company in recent acquisition or mergers to derive the valuation for benchmark. So we will see recently purchased company, based on that we will go with the derived valuation benchmark. For example, determining the value of manufacturing plant by examining the sale process of similar plants in the same region in the past year. So we are establishing new manufacturing. We will see old manufacturing, if any manufacturing is sold around that area in last 1 year, we will see based on that. First term precedent transaction analysis, so previously is there any transaction same like as. And another method we have discussed, comparable company analysis. Next another method will be NAV, that is net asset value method. Here net asset value method approaches will be value of a company based on the fair market value of assets minus its liabilities. So we will see whatever the assets, what are the liabilities, and we will deduct from the assets the liabilities, then we will see. And often used for asset heavy companies or investment funds. For example, calculating NAV of a real estate trust, that is REIT, by valuing its properties, subtracting its debits and dividing by number of outstanding shares, that is NAV method. And another method will be replacement cost method. Here in replacement cost method, estimate the cost of replacing an asset with similar company utility used for specialized or unique assets. So we will replace an asset with similar one equal utility or using some specialized or unique assets. For example, assessing the value of custom built manufacturing machine by determining the cost of building new one with equivalent capabilities. So we are constructing one building, but we have some other building only, we are customizing some modifications. So we will see that cost. Next, market multiples approach. Here market multiple approach means applies industry specific valuations multiples. For example, if you go for the articles, what the principal will be tell. So what is the my stipend means, as per NASMA they will tell the single answer. So as per industry norms they will go with these cases. So as per applies industry specific valuation multiples, that is price to book or price to sales to company's financial metrics to derive its value. Next, here for example, valuing retail company using price to sales multiple based on average multiple for retail companies in same sector. Another one, income approach. Income approach means for real estate. For example, here approach will be values of real estate based on its potential to generate income. What are the generating income for real estate? That rent or rental income or capital appreciation or other revenue streams. What are the revenue streams will be there? Based on that income approach, we will find out the value. For example, determining the value of an apartment building by estimating its annual rental income and applying the capitalizing rate. So present value of cash inflows, that is the case. Now we will know what are the key components will be included in private equity fund financial statements. So what will be included in financial statement of private equity? Firstly, we will include statement of assets and liabilities. So in the statement of assets and liability, we mainly focus on investment details. So in investments, what are the details of fair value of investment in portfolio company and classified by investment stages and industries, other relevant categories we will see. So firstly, in statement of assets and liability, we need to see relating to investment details. After that, cash and cash equivalent details. So we need to see about showing available cash on hand and highly liquid assets, what are there we will see. So first we need investment, after that cash and cash equivalent and receivables. What are the receivables is there, that is including amount owed to the fund such as management fee, carried interest and proceed from asset sales. They are receivables for fund house now, they will see. And payables represent amount owed by the fund such as expenses, fees and taxes will be there. After that, deferred revenues. So here reflect unearned management fees or other revenue that will be recognized in future period. Next, after that, statement of assets and liabilities, we have statement of operation. Here statement of assets and liabilities means in our language it is balance sheet, just as balance sheet. So in balance sheet main will be investment, cash and cash equivalent, receivables and payables and deferred revenues. After that, statement of operations. In statement of operation, we need to see mainly that revenue, expenses, net income and losses. So revenue means it will may include management fee, carried interest income, dividends, gain and loss on investment, that is revenue. And expenses cover operating expenses, that is salary, rent, technology, transaction cost, professional fee, interest expenses, etc. And net income means funds, profit or loss for the period. Here balance sheet as on balance sheet. Now statement of changes in net assets. So in the net asset statement, changes in net assets, see what is the beginning, what is the net income is added, what is the net loss is deducted, what we have distributed now at the ending, what is the NAV, the fund NAV at the end of the period we will see, that is changes in NAV. After that we will see that statement of cash flows. Here statement of cash flows, we have three activities. One is operating activity, one is investing activities, one is financing activity. So in operating activity we see that cash flows from operating activities such as management fee received, expenses paid, investment income, etc., etc. And after that investing activities, so cash flows from investing activities such as acquisition and disposition of investments. Next, financing activities, here cash flow from financing activities such as capital calls and distribution to investors. Now notes to financial statements, so notes to financial statement means it will include some significant accounting policies or investment portfolio details or management fee carried interest. So significant accounting policies means detailed description of accounting method used for valuation. So what are the valuation methods we have used, what are the accounting methods we used, that description will be detailedly provided in notes to financial statement. And what are the valuation we have used, what are the revenue recognitions, what are the expense treatment we have taken for significant accounting policies. For that we will provide the detailed description of this related. And after that in notes to account investment portfolio details, that is information about portfolio companies where we have invested, what are the names of that company, what is the industry, what is the valuation, what is the ownership percentage will we held. Next, after that management fee and carried interest, we will explain the fee structure and performance based compensation arrangement, what method we are using, whether European waterfall method or American waterfall method, or how the fee structure is there, the 20% is there or 20% is there, how the cash up, how the preferred return, how the profit sharing ratio, this all will be explained in notes to account. Next, related party transactions, here disclosure of transactions with affiliates. So affiliates means we have discussed that master feeder and master and feeder affiliate related entities. Risk and uncertainties, here discussion of potential risk that could affect the fund's financial performance, what are the risks and what are the uncertainties which are potentially affect the fund for financial performance. Now additional information, in addition to notes to account they will also provide some additional information which is management discussion and analysis, MDA, that is insight into funds performance, strategies, risk and future outlook. Now portfolio companies financial information, that is selected financial information for portfolio companies are providing deep for understanding of their financial health and prospectus will be there. For example, mutual fund example, Fidelity Magellan Fund is there. So what they will do first for preparing the financial statement, what can the content we will gather, what are the documents we will gather, what are the requirements will be there in mutual fund, in private equity. So in mutual funds, for example, we will take the Magellan Fund. So for the Magellan Fund they will gather data first. In gathering data, Fidelity manages the Magellan Fund internally. So all financial data resides within the company. So all the data will be within the company. They collect investment transactions, fee earned, expenses incurred, market values of their portfolio holdings. So they will collect the information firstly. After the collecting the information, they will prepare the trial balance. So they will involve listing all accounts including cash, investment holdings, receivables, payables, deferred revenues, accrued expenses, whatever the entries they will post, and they will prepare the trial balance. After that, record some adjustment entries, that is Fidelity might need to adjust for accrued management fee, dividend income not yet received, which have right to receive is established, potential changes of fair value of certain investments. After that they will prepare the financial statement. Financial statement means we are included that statement of assets and liabilities, now that is statement of assets and liabilities and statement of operations. In statement of assets and liabilities they will list assets, investment like we have invested in Apple and Alphabet, that is Google, along with cash they will provide the cash and cash equivalent and outstanding payables, deferred revenues. Next, statement of operations, here they will provide the incomes. So what are the incomes? Management fee earned, dividend incomes, generated portfolio of holding and operating expenses incurred. Next, after that they will provide statement of changes net asset, that is showing beginning net asset what is their, net incomes what is their, distribution, investment, ending value. And statement of cash flows means they will income from management, detailed outflow, operating expenses, distributions, preparing notes to account. In notes to account, prepare the explanation about fidelity valuation method, fee charged, portfolio composition, risk factor they will provide, and after that they will review and finalize it. That fidelity internal accounting management team, which is the accounting team, they will management review the financial statement for accuracy before finalizing them. Now after the review they will send the data to auditor, who is the independent auditor like Deloitte or Touch LLP audits the financial statement annually to ensure the compliance with GAAP, that generally accepted audit generally accepted audit procedures will be there. They will see in accordance with that cap. So they will give the opinion on that whatever the we are prepared. Next, private equity. Here private equity will first they gather the data. For example, we will taking Blackstone Capital Partners. So Blackstone will track all investment transaction, fee income, expenses, performance based compensation across diverse portfolio. After that they also prepare trial balance. So in trial balance we have various companies, cashes, receivables, payables, accrued expenses, deferred expenses. After that they will record general entries. After the recording of general entries they will prepare the financial statement. What are the statements will be there? Financial statement will be there. Financial statement will be include statement of assets and liabilities, statement of operations, notes to account, cash flow, statement of operations, statement of changes in net assets, statement of changes in cash flow, notes to account. So in statement of assets and liabilities we are already told that Anstar company we are invested na, Hillstone Worldwide holding along with cash and any outstanding payable deferred revenues is there. And statement of operation means what are the details of management fee, what is the carried interest earned. In mutual fund we have only management fee, here they have carried interest earned alongside operating expenses, any interest expenses incurred. And statement of changes in net assets, here includes beginning net asset value, net incomes are loss distribution to NAV including in net asset value. And after that statement of cash flows, here cash flows inflows from fee, investment exits with outflow for operating expenses and distributions. Prepare notes to financial statement. Here Blackstone's valuations, methodologies, fee structure, performance-based compensation calculation, and all details about the specific portfolio companies. Review the finalized, and internal accounting team will review that financial statement. They will send to Blackstone. So Blackstone typically does not require external audit due to its limited number of investors, but they might engage an auditor for specific transaction or due diligence purposes. This is related. Now we are preparing the financial statement. How frequently this preparing financial statement and other report will be significantly different from investment vehicles. So for example, mutual fund they are preparing financial statement now. Mutual funds are required to prepare audited financial statement annually. So annually, and these statements are publicly available and filed with SEBI, that is SEC, that is Security Exchange Commission. And additionally mutual fund may publish monthly or quarterly shareholders report with summarized financial information and performance update. So they will monthly or quarterly shareholders report will summarize the financial information. And after that private equity funds. So private equity funds generally do not have publicly traded shares. So they are not subject to same reporting requirement as mutual funds. So they typically prepare audited financial statement annually for internal purpose and for limited distribution to investors. So the statements are not publicly available. So if you see that we do not get the private equity funds related financials in publicly available. Now quarterly or semi-annually investors report. So PE funds often provide investors with quarterly or semi-annually reports containing performance update, portfolio company information, and key financial metrics. And exact frequency and level of details vary depending on the specific fund and investors agreement. And here they may have that PCAPs, that is partner capital account, they will provide. And after that these hedge funds also similar to PE funds. Hedge funds are not publicly traded and do not have same standard reporting requirements. So they will prepare audited financial statement annually for internal purpose and limited investor distribution. However, compared to PE, some hedge fund investors might request more frequent reportings because they have So with detailed performance and risk analysis, so they will provide monthly and additional reports. So here they will provide additional reports, means this fund performance report. So all three type of fund may generate internal or investor specific reports focusing on performance analysis, attribution of returns, and portfolio risk metrics will be provided, and regulatory filings depending on their source and legal jurisdiction, that mutual funds or private equity or hedge funds may need to file periodical reports with regulatory bodies like that is Security Exchange Commission or local financing authorities will be there. They have specific sequence and formats of reports differ based on the fund agreement, investor requirement, and regulatory landscape. So yeah, they will provide. Now these mutual funds, so we have calculating of NAV will be there. So NAV depends on types of fund you are considering. For mutual fund, NAV is typically calculated on daily basis. So after the close of market timings will be this 9:15 to 3:30. So after that they will calculate up to 11 p.m. they will update the NAV. So on daily basis, the formula will be for the calculation of NAV: total assets minus total liability divided by number of outstanding shares. Next, total assets. Here total assets means this includes market value of all portfolio holdings, cashes, and any accrued incomes. So it will include here balance sheet. Here whatever will come na, this will come here. So includes here market value of all portfolio holding, cash, any accrued incomes. Here total liabilities. Here any outstanding fee, payable, accrued expenses is outstanding expenses. Next, number of outstanding shares. But we should not in liability we should not take this equity. So in balance sheet we have assets, equity, liability. So from this assets we will deduct this liability only. We should not consider this equity. That is the case. So there is this represent total number of shares owned by the investors. So NAV will be calculated daily basis on mutual funds. Whereas private equity funds, in private equity funds, I think 52, okay. Private equity funds, in private equity funds, NAV will calculate as usually done quarterly or annually, depending on the fund's terms and investor agreements. So the formula remains the same, but valuing assets for private company represent challenges. So for valuing they will use that level 1, level 2, level 3 we have already discussed. In level 1 means it is readily available market price which exists a similar public company they can use to estimate the value of private company. Whereas level 2, here if no public market comparison is exists or valuation model based on the financial metrics and industry benchmark might be used. So similar asset values will be used. Whereas level 3 we should not have similar asset and we should not have active market. So here we will go with the some techniques for some adjustments, some projections we will use it. So no comparable data will be there. So internally forecast or discounted cash flows we will use analyzed for might be necessary. And now for hedge funds NAV calculation can be complex and require expertise in valuation methods. NAV, yes. Now another question here, some cases is it possible NAV become negative? Means that question answer will be yes, because yes it is possible for a fund to have a negative NAV. This typically occurs when the combined value of the fund assets fall below the total liability. So we are taking here assets minus liabilities divided by number of units. So if the liabilities increase, assets is decrease, we will get the negative NAV. It is the case. It means negative NAV. For example, for P equity, this is only they will do not invest any amount. They will assets means they will not invest any amount. They have expenses payable will be there. We discuss about J curve. J curve means what? Initially they have only expenses, means it will payable. So number of units will be there. So we will get the negative NAV. That is here we are discussing. Typically occurs when combined value of fund assets falls below the total liabilities and outstanding shares. So while no common it is scenario, the investors and fund managers need to be aware. Why? Reasons for negative NAV or wrong NAV. Firstly, significant market downturns. So, where we are invested some assets, the assets value will go down. Here, when the market experiences sharp decline, the value of the fund portfolio holding can drop significantly, leading to negative NAV. They are common in private equity and hedge funds, which invest in less liquid assets compared to mutual funds. Next, excessive leverage. Your borrowing is more than the investments. So you are not taken from the persons, your borrowings will be high. So because we are taking for assets, equity we are not considering. Other than equity we are considering all. So borrowing is more. We are not taking committed capital is there, but we are not taking contribution from our investors. Then it will become NAV negative. NAV will become negative. I think just a second. Where is the excess leverage? Losses are magnified, potentially pushing NAV into negative territory. Next, misvaluation. This year, inaccurately valuing assets. So, particularly illiquid assets. One is private equity can lead to be an inflated NAV. So, for that we are using level 1, level 2, level 3. Now, in level 2, we do not have the active market because we are going similar assets. So we are taking two buildings, but one building is hospital, one building is bungalow. So the we prices compulsory they have difference. So what we are telling similar asset means this is building, that is building. We are giving the reason that only, but purpose is different. When purpose is different, the valuation also different. So when valuation is different, when valuation is wrong, the NAV may become negative. Next, redemption pressure. So the private equity funds will invest in illiquid assets. They have period, that is maturity period will be 1 to 5 years or 1 to 10 years. So at the time of 10th year or 8th year, they need to pay all amount to their investors, because at that time when he want to pay more amount, he will get the more pressure. When he have more pressure, he will commit more mistakes. So it is suicidal, what we will tell na, some suicidal situations, that cases will be arise. So large number of investors redeem their shares. At the same time, they can force the fund to sell assets at discount, further contributing to negative NAV. There are consequences. What are the consequences if NAV is negative? Here investor will lose, because based on that NAV only the investor get the amounts. Because the investor the NAV is negative, then a negative NAV means investor holding or worth will be less than their initial investment. This can lead to significant loss for investor, particularly if they redeem their shares at the reduced NAV. So if you have more positive high NAV, then at that point of time, if you sell, you will get the more profit. If you have negative NAV, if you are selling, you will not get any benefit. Next, reputation damage. If NAV is negative, firstly we will issue that what is this na? LPA PPM, that is private placement memorandum. In private placement memorandum, what we said, that is a prospectus which will include the past performance of the company. Past means last fund, how we raised, how we distributed. That when we quote this negative NAV was there in, when the performance is not good, how the new investors will come. So it will reputate the damage of the company. Next, liquidity concerns. So a negative NAV can raise concerns about fund liquidity, as it may difficult to sell assets quickly to meet the redemption request. Next, for addressing the negative NAV, we need to perform improvement. So the fund manager can implement strategies to improve the performance of the portfolio. Then NAV may increase. This may involve active portfolio management will be required, and cost cutting measures will be required, and fund restructuring will be required. Next, investor communication, where we need to transparent communication will be required, and investor crucial during time of negative NAV will be required, and fund manager should explain the situation and outline their plan for recovery. So this is the situation. Because of this situation, we got the negative NAV. If this is the strategy we are going to get positive NAV. We need to explain. Next, capital injection. In some cases, the fund may raise additional capital from investors to increase its asset base and improve NAV. This is the case. And in master feeder and feeder structure, we have some TDS entries also there, withholding of taxes. And when some in financial statements, we need to highlight some financial highlights. So some expenses, that is like this IRR, internal rate of return, or expense ratio, we need to highlight. This is financial highlights. So TDS means it is deducting some amount and paying the amount, remaining amount. Financial highlights means this may include NAV, the par value of shares of the fund. We need to include financial health. Total return, the percentage of change in NAV over a specified period, how much percentage it was changed. Now expense ratio, annual cost of operating the fund has percentage of its average net assets. So what is the cost, average operating cost, and through with compared to average net assets. Next, Sharpe ratio or Sortino ratio, these are like IRR ratios only. Next, calculating of NAV involves complex interplay market data. So here and accounting process even more. This is not data NAV, some potential reason for incorrect NAV. So why the NAV become incorrect? So we have seen NAV, negative NAV, and reason for negative NAV, and come across with from some strategies. Now incorrect NAV. So reason for incorrect NAV here, because of data errors, incorrect, inaccurate, or outdated market prices we are considering. So relying on still or erroneous market data for listed investments can significantly skew the NAV, or miscalculation or typos. So in place of 100 we are added some 0. Then it also data entry mistake. Calculation can also lead to discrepancies. Incomplete data. There has missing information about certain assets or liabilities can cause an incomplete picture of the fund true value. Next, valuation challenges. Here, subject to inputs in illiquid assets for private companies or other non-traded assets. Valuation often relies on estimates and models, introducing the risk of subjectivity or changing valuation methodology. So, shifting between different valuation methods might not be smoothly reflected the NAV, leading to potential inconsistent or overstated or understated asset values. So over optimistic or overly pessimistic also assumptions also NAV will be there, and some other issues will be there. Some regulatory issues will be there, and some taxation issues will be there for this private equity. Some taxation issue means where they need to pay some tax to different. Sometimes it may pay 2 times, or sometimes it may pay 3 times. Where fund is registered, where it is distributed based on source, where resident is there based on resident source. So they will collect the tax based on that. So we have some issues. That issue also there, and improper or deferral, inaccurate treatment of fees and expenses. So whatever the fees, whatever the expenses properly not considered, or systematic accounting errors is there, or technical glitches of systems or failures is there, or fraudulent activities is conducted, manipulation of data. Then also, and delayed information updates. So updates are not updated within time, and investor losses. So inaccurate NAV can misrepresent the value of investors holding, and regulatory issues. Some non-compliance with NAV calculations standards can attract scrutiny and penalties from regulatory bodies. Reputational damages. Some consistent inaccuracies in NAV can damage the fund manner or reputation and code. And preventing or mitigating errors, robust data valuation, strong internal control is not there, transparency and communication will be not there. In financial statement, in notes to account, we have seen the different. Now, in that we need to know more on some terms. Here one will be management asset, means Here management offset means investor in private equity funds often pay management fee based on committed capital amount. However, if actual investment falls short of commitment, the manager might offer an offset by reducing the fee proportionately. So, catch up provision means fund house will pay to general partner. Clawback provision is there. So, in clawback provision, general partner need to pay that amount to fund house. So, here same person is payable and receivable. Then we will offset that amount. For example, assume invest company commits $100 million to Blackstone fund with 2 months an annual management fee, but the fund only deploys 80 million due to market conditions. Blackstone might apply 20% offset, so reducing the annual fee. And after that, broken deal. Broken deal means here concept what we tell now sometimes deals agreed. We are agreed the deal to certain companies upon some between private equity fund and target company fall due to various reasons. So after agreeing, after we complete the deal, the shares may down or funds may down. Some other reasons, because of some reasons, it was target company will fall down due to regulatory hurdles or financing issue or buyer's remorse, or they are hidden some liability they are not disclosed with us. Because of some other reason, the target company will fall. When it fall, we should not enter into with that company. Then we will broke the deal. Whatever the deal we are enter na, the deal will broken. That is broken deal. Here KKR might agree to acquire a software company for $1 billion, but encounter some antitrust concern during the regulatory approval. If the deal is ultimately falls through, KKR incur some expenses like due diligence cost and legal expenses, which become broken deal cost, so impacting their financial. Next, due diligence cost. Yeah, due diligence cost means before investing in company, we need to conduct some investigation on which company we are going to invest in to assess its financials, operations, potential risk. The investigation incur various costs. Now, the example, Silver Lake partners might spend millions of dollars on legal or accounting and industry experts fee while analyzing a potential acquisition in the healthcare sector. So, the DD costs are treated as expenses before investment decision is made. After that, we need to know about equalization and rebalancing. Here, I think just a second here. After the equalization and rebalancing, I think I will take in next video. Yeah, it will be how anything. I think to need to discuss about 45 means 550, 10, 60, 70, 20, 22, almost 25 pages is there na. So I will discuss in next class this. We are stopped at broken deal. You need to discuss about equalization, rebalancing. After that, hedge funds. After that, one bond we will discuss about the zero coupon bond. After that, we will discuss some derivatives like forwards, futures, options, call option, put option, swaption we will discuss. After that, we will discuss some information relating to some AUM, asset under management, AUC, that we will discuss some topics, miscellaneous topics. So after the hedge fund, we will discuss the miscellaneous topics. So next video will be main focus on hedge funds is the main focus. After that, we will discuss some miscellaneous topics. It will complete the topics of fund accounting. So thank you now. Thank you.